Good morning, everybody. I'm sure all of you are fine. Now, today we were actually, the other day we were actually discussing on some special types of vehicles, which involved specialized industries, what we call as a shipping company and an airline company. And then for the shipping company, we understood that there was this treatment for shipping and airlines that are resident companies and non-residents. So for the shipping companies who are resident and airline companies that are resident, you actually tax on a worldwide basis. And but for the shipping companies who are meeting certain conditions and criteria, who are resident, right? So resident shipping companies like MIC will be able to actually enjoy a 100% statutory exemptions, provided they meet these conditions, right? And then, but the non-exempt ships, right? So if you're a Malaysian ship and you're seagoing and you meet certain criteria, register with the MSO, you can get 100% exemption. But otherwise, you have to pay normal tax, like barges, ferry is a normal operation, so there's no exemption for that. But for non-resident shipping and airline companies, they have a very simple treatment. There are two methods. One is a 5% deemed statutory income method, right? So you take your gross income and take 5%, and that will be deemed to be part of your statutory income, and then you can claim any appropriate deductions such as contributions to charitable institutions, subject to 10%, and then arrive at chargeable income, your tax rate is 24%. And for the other method would be the ratio certificate method, where we have to get certain information from the revenue authorities, which shows certain gross world, the gross adjusted income, the gross income adjusted income for the world, and gross capital allowances for the world, and then the gross freight earnings, right, for the world, and then you take the Malaysian portions after deducting any transshipments. Okay, so that was something that we had already discussed. But today, we will move on to something called insurance. Okay. Now, we were briefly discussing about insurance the other day, but basically, as far as the insurance industry is concerned, there are two main types. One is the life insurance, and the other one is the general insurance. Okay, so as far as the life insurance industry is concerned, not all of them actually do both. There are some who only do one, but we need to separate. If one company has got life and insurance business, the other one has got general insurance, it is assessed separately. It's got some unique rules. Now, under the life insurance, you've got two types of funds. One is called the life fund, and the other one is called the shareholders fund. Okay, so we will actually deal with the life insurance, i.e. life fund first, and then we will also deal with the shareholders funds first. Then only after finishing doing an exam question, we will go to general. Okay, so now let's actually focus on some details. Okay, now as far as let's say, for example, we are actually getting the license to actually operate a insurance company. Okay, let's say, for example, IRUM has got say Sindian Berhad, say Global Insurance Malaysia Sindian Berhad, and we focus on life. Okay, so let's say, for example, now we go and try to sell insurance policies for an individual, let's say your cousin or your uncle, right? Now, when the insurance company is issuing, so let's say, for example, your cousin is actually now taking a 50,000 ringgit insurance policy, and she has to pay 3,500 annually until a certain period of time, after which it will be redeemed, and there are certain terms. Okay, so when the insurance company is now receiving this insurance premium, right, the gross premiums from issuing policies received by the insurance company is not subject to income tax. Okay, so whatever you sell a 1 million ringgit insurance policy to your dad, and when the insurance company receives the insurance policy, let's say the insurance premium is say 18,000 per year, so that 18,000 is not subject to tax. But at the same time, if there are any claims incurred under the life insurance policy, you cannot claim. Okay, so any expenses associated, unless it is specifically deductible, any associated expenses relating to that premiums is not deductible. Okay, it's not deductible. Okay, so things like if there's any management fees incurred for your life insurance, life fund, and the shareholders funds, you won't be able to claim. Right? Let's say, for example, our company actually appointed agents. Right? That's how it operates, right? So you normally are probably going to be receiving a call from an agent. Now, when we are paying commissions to the agents, it is not deductible. Why? Because we have a unique treatment where the gross premiums from issuing policies from life fund is not subject to income tax. So therefore, the associated expenses such as your management fees, your commissions, right? Any associated head office expenses. It's a Singapore-based company, so they're charging head office expenses. Under the life fund, you cannot claim a deduction. Okay, even though it may be deductible for income tax purposes, but under the insurance treatment for life fund, you cannot claim. Okay, now let's say, for example, now our company is actually doing extremely well. We are sitting on a pool of money, right? Our inventory is cash, right? So every one of us, all of us, right? All 70 of us are now working for this group, and we are now selling insurance policy to uncle, auntie, friend. We haven't met with a friend for so long, then we call them and say that we want to introduce something to you, right? So we're sitting on cash. So basically, as far as the insurance industry is concerned, our insurance company, the inventory is actually equivalent to cash. Okay, so can you imagine? Yeah, let's assume that we are now sitting on, say, 1 million or 2 million worth of cash, right? So what we're going to do is we are not going to sit quietly. Okay, so we're going to start investing. Okay, so we're going to start investing. So we're going to buy, say, Sapura shares for 100,000, right? That 100,000 cost, ladies and gents, would be deductible. But when you sell the shares for 120,000, the gross proceeds from realizing your investments or your shares is subject to tax. Okay, so let's say, for example, you bought Sapura shares for 120,000. You can claim 100,000, sorry, and then you sold it for 120,000. You have to bring to tax 120,000. Okay, so the cost relating to investment. Now, why is that subject to tax? Right, because you're basically carrying on a business. It's actually accessible under Section 4, small a business source. Okay, so whatever they do with the cash, with the inventory, right, they cannot claim it as capital, because we actually don't have capital gains tax in Malaysia. As you know, Malaysia is like a few economies, like Singapore, for example, like Hong Kong. Some Asian economies, what they do is when you sell your investment, let's say, for example, now you're working in a bank, right? So you get your bonus of 10,000. You go and invest in shares. When you buy your shares for 1,000 ringgit and you sell it for 1,100, that is actually a capital gain, not subject to income tax. But that, right, is a capital in nature, because you are not in the business of buying and selling shares. You are an employee of a company and you're just making some investments. Okay, but in this case, for the insurance company, it is regarded as carrying out in the normal course of their business, right? They go make investments, they make money, sometimes they lose money, no problem, you just can claim. Okay, so that is a unique treatment given for the investments. Okay, investments. Now, what about returns on my investments? Returns. Okay, so I'll be actually now investing in, say, for example, shares in a Malaysian company. When I receive it, it is tax exempt. Okay, that's what all of you correctly told me the other day. When a BISA or BISA, right, the bank, insurance, C and undertakings, including insurance companies, when they receive, regardless of who the shareholder is, under Para 12B, it is tax exempt, even for the insurance company and also for the it is tax exempt. Okay, but let's say, for example, they have investments overseas and they're receiving dividend income, that would be actually assessed to tax when they receive it. Okay, so that is not exempted because they're part of the BISA. So Para 28 Schedule 6 is not given to the 4 resident businesses such as BISA, which includes insurance. Okay. Okay, so now let's say, for example, I'm actually investing in properties, right? I'll be receiving rental income. I'm investing in properties. If I invest in properties and if I'm renting it out, I will receive rental income that would be subject to tax. Okay, so even though it was an overseas property, also foreign source income is not applicable for insurance companies, so they will have to pay tax upon receipt. Okay. So now for the life fund, right? For the life fund, they can claim cap allowances. So it's a normal treatment. You have cap allowances for your business, so your laptops, right? You can claim cap allowances, your office, right, equipment, your conference tables, everything you can claim. And you can also claim any unabsorbed losses that you had brought forward from the life business, right? And lastly, for the life fund, ladies and gents, we have a very unique rate under Schedule 1 of 8%. Okay. Now, this is the rate given for life insurance business, life fund, right? Whereby they're encouraging, right? It's sort of an incentive given to them to set up insurance companies in Malaysia, because the government feels that investing in insurance is actually a very important part for the individuals who are investing, or because you need to look after yourself when you need it. So the Malaysian government is actually very encourages insurance companies to be carrying on life insurance, and it's very big. We have many, more than 20 insurance companies, right? We have Allianz, and we have Great Easterns, and Takaful is actually doing extremely well. Okay, and okay, so that is the treatment for life fund. So let me summarize. Okay, for the life fund, gross premiums, when you are now issuing it for an insured individual, when you receive the premiums, when the insurance company receives it, is not subject to tax. Okay, but if they buy any investments, that cost is deductible. But when you sell the investments, that gross proceeds is taxable. Okay, so for a tax computation for life insurance, ladies and gents, you need to now show the gross income that is subject to tax. Okay, bring to tax whatever that is subject to tax, right? Whatever is not subject to tax, you write that gross premiums for insurance policies is nil. Okay, it's not subject to tax. Okay, then if you have any expenses, management fees, expenses, commissions, sorry, you cannot claim. Claims incurred, you can't claim. Okay. Also, if there's any taxable returns in investments, such as interest income, dividend income, and rental income, depending on what type of income you're receiving, it is taxable and non-taxable. Okay, so if it's taxable, bring in that amount. Okay, you can claim, life fund can claim cap allowances. The life fund is a normal tax treatment. After your statutory income, you can claim unabsorbed losses. And then once you arrive at chargeable income, you take 8% and calculate the tax payable, and you will be given the appropriate marks. Okay, now may I ask you, is there any questions?
No.
I'm sorry?
No, sir. All is good.
Oh, that's very good. Because my apologies, because last time I was like a bit of a train, a bit too fast, but I realized my mistake, and I'm very sorry about it. Okay, so now let's say now we are now extremely doing very well. By the way, we are receiving interest income, we are receiving dividend income, we are receiving rental income. We are, we have huge investments. We are making, our cash position is very huge. It's already approaching about nearly 10 million, right? And our company is doing extremely well. But ladies and gents, now for the under the life insurance business, there's another category called the shareholders funds, and basically I'm going to give you an example, but that's just to try to explain to you what it means. Actually, it's not, but it's just giving you a guidance on what it means. So let's say, for example, now we have issued about, say, 105 policies, right, to various individuals, and now we've actually got to go to an actuarist. I don't know, but you might actually have friends and relatives who are actually actuaries, right? Actuaries are basically people who assess risk, right? So mathematically, let's say, for example, all 105 policies mature today, right? Today, my cash balance is 10 million. And we ask the actuaries, hey, I wanted to assess my risk. Okay? What happens if 105 policies mature today? How much you got to pay out? He's a genius, right? He's very scientific. He mathematically actually determines the amount, and he says, even if the insurance policies mature today, you have to pay only 9 million, and your cash balance is 10 million. You have so-called made an actuarial surplus. You're so-called, you're not made anything, So you have now so-called made a positive. Why? Because your cash balance based on your cash and your assets is 10 million. If there's if there's a risk of all the policies getting matured or realized, you have to pay only 9 million. So effectively, you have made so-called 1 million. That surplus, ladies and gents, has to be brought to tax as part of your gross income. Okay, so under the shareholders' funds, we will allocate an X amount and put it under the shareholders' funds, and they will also be investing. So under the shareholders' funds, we'll keep it separately, and they will invest and maybe get some interest income. They will receive some rental income. They'll receive some dividend income, depending on whether it's a Malaysian company who's paying the dividend income to us, the Malaysian insurance company. Then it'll be tax exempt. Otherwise, from overseas means you have to pay tax. Okay, and you don't have any other expenses. You don't have any expenses. But of course, everything has got two sides, right? Every coin has got two sides. So let's say, for example, you ask the actuaries, hey, my cash balance 10 million today. If 105, all my policies mature and realize how much is my payout. Okay. So he calculates and he tells you, oh, you have to pay 10.1 million. Oops. I've only got 10 million, ladies and gents. That 100,000, that's so-called deficit. It's a deficit that effectively will be transferred from the life fund to the shareholders' funds, will be deductible for the shareholders' fund. SHF it's called, right? SHF. So shareholders' funds, you minus the deficit. So in the question, if they tell you it's a surplus, then you add. But if it is a deficit, then you minus in arriving at your adjusted income. You cannot claim cap allowances. You cannot claim losses, and your chargeable income is subject to the highest rate of 20. Normally they're not SMEs. They can't, because they are highly regulated. Their share capital is it can't be less than 2.5 million. You won't be able to operate an insurance company just like a bank. Okay, so your tax rate is 24% on your chargeable income, right? So you don't claim any cap allowances, losses, right? Any expenses, right? What you do is you just simply bring into tax your investments that you realized, right? So let's say you bought Sapura shares or public bank shares for 80,000 and you're selling it for 160,000, right? Let's say, for example, we invested in glove manufacturing companies, right? So let's say we bought glove manufacturing company shares and we bought 100,000, and today I think we can sell it for 300,000, right? Because those stocks actually do quite well. So the 300,000 will be subject to tax because it's part of their ordinary course of business. So it's a business activity. So that'll be for ASOS, right? Business source, you have to pay tax. And then, of course, let's say, for example, we have given loans, right? We have given loans, or we invested in certain instruments which generate interest that will be subject to tax, right? And also for dividends, depending on where it is from, and rental income. But if there's an actual surplus, you need to bring it to tax. Okay, actual surplus, you need to bring it to tax. But you can claim the cost, no problem. Your glove companies, you bought for 100,000, you can claim. But of course, don't forget to bring the 300,000 when you sold. Okay, so you can claim the cost of your investments or shares realized, and then your actual deficit in arriving at your adjusted income. There's no cap allowances, so your chargeable income will be taxed at 24%. Okay, 24%. Clear, gents? Now, may I ask you, is there any questions? Wonderful, wonderful. Okay, wonderful. Now I'm going to go to this exam question paper. Okay, I'm going to go to this exam question. Right now, I'm not seeing your book yet. We've got to go to your book shortly. Okay. So now I want to go to this. Right, I want to go to this. Okay, I want to go to this insurance company. Okay. So you go to question 3A of 2018. Right, what's it called? 20181 sub, right? Sub means sub. Sorry, that means it's very easy. So one sub, right? 2018, one sub. And let's say there's a question 3A for how many marks? Let's say it is 10 marker. So 10 marker in your exams is about 20. 10 times 2 is 20. So 20 minus 10% is about 18 minutes in the exams. Okay, so that's how you manage your exam when you're doing the exams. Okay, not to worry about it now. Okay, now I just want you to read this question. I just want you to read it. Okay, we're not going to do this question. I just want you to read the question. That's all. Okay, ladies and gents. Now let's say I've got this CCP Insurance Bahar, CIP, right? CIP, a Malaysian resident. They've actually given you certain details on life fund, shareholders funds, and general fund. We'll just ignore the offshore business now, right? So under the life fund, they actually give you some details saying that we have gross premiums, we have some dividend income, but the dividend income, they give you some notes. They give you a note, okay? Then for the insurance income, they have rental income, they have some proceeds from selling their shares, right, for 12 million, but they actually bought it for 7 million. Okay, they bought it for 7 million and they sold it for 12. Okay, and then they incurred some commissions, right, some management expenses, right, and then there's a note for management expenses. Then there is a what do you call it? Reserve fund for UPR, surplus. Surplus. Oh, that sounds interesting. Okay, surplus. Okay. Then for the then they actually gave you some details on the shareholders funds where they're receiving some dividend income. And then they gave you some notes. They gave you something on premiums for general insurance. We have no idea what general is, right? We have no idea. But the dividend income is relevant for us, right? And then they gave you some capital allowances for the life insurance business. And then they said, compute the tax for the different businesses that you have on top, okay? Compute the tax for the different businesses that you have, okay? So this is basically a question that involves life fund and shareholders fund, which is made up of insurance, right? Now, we will come back to this question, okay? We're not going to do this question now, right? We're going to come back to this question because after you finish your text only, you will do this question, okay? But this is what, okay? Now, let's say, for example, I ask you a very simple question, okay? Now, for the life fund, right, if I was to ask you, will the gross income includes the gross premiums issued, right? Gross income from insurance policy issues under the life fund of 60 million. Is that subject to tax or not subject to tax?
Not subject to tax. No.
It is not subject to tax.
No.
Okay? So if I were to ask you the question, you would say it is not subject to tax. Okay? But of course, the returns and investments, sorry, that depends on what type of investment returns you're receiving. That depends. Okay, that depends. Okay. Now, the tax rate for this life fund also, it is something very unique, right? We don't actually have many, and we don't have many with a 8% rate. Okay, so that 8% on the chargeable income would apply for the life fund. Okay, and as far as the actuarial surplus and actuarial what you call deficit is concerned, that is only applicable to the shareholders funds, right? It does not apply to any others. It only applies to the shareholders funds. And if it's a surplus, what we understood is you just simply add as part of the gross income. But if it's a deficit, then you can actually minus. Okay. Okay. So we'll come back to this question. Okay. We'll come back to this question. Okay, so now let me just go back here. Okay. Ladies and gents, I'm very happy to inform you that our company is doing extremely well, right? And in the next board of directors meeting, ladies and gents, we have actually adopted a policy that we are going to go into the general insurance business, right? Okay. Okay, ladies and gents, we are going to go into the general. So you know what to do. Go and ask your uncle and auntie whether they want to insure your car. Please ask them to come to our company and insure it, right? So we start selling, ladies and gents, the insurance, right? You know how it works, right? Insurance for, right? General insurance covers things like cars, right? Buildings, right? Contents, right? For houses, contents, and for buildings, right? Now, let's say, for example, KLCC, right? Let's say the KLCC, right? Let's say, for example, we have Dr. Salwa, who actually knows somebody in KLCC. She knows the CEO. She goes in and she meets up, and suddenly, ladies and gents, we receive the contract for KLCC, and let's assume that the insurance premium is 80,000. We get 80,000. Okay. Now, under the general insurance, ladies and gents, the income from gross premiums issued, right, from policies issued on the general insurance is subject to tax. The 80,000 premiums, the annual premiums paid by the insured to us, to the insurance company, is subject. The 80,000 would be brought to tax as part of the gross premiums, but no problem. Let's say there was a small fire in KLCC, and there was a small damage, and they made a claim. Let's say we made a payout of 5,000. No problem. Go ahead and claim it. Okay, you can claim any deductible management fees, any commissions from summer. Everything is normal, right? So your head office expense allocation. Let's say, for example, you've got, say, Tokyo Marine Insurance from Japan is actually allocating some expenses that relates to the Malaysian business. As long as it's deductible expenditure, right? As long as it doesn't include depreciation, no problem. You can claim the allowable expenses. And let's say, for example, you actually get receiving returns on your investments, and your that will be subject to tax depending on what you receive. And you definitely, if you're going to invest, make investments. So the cost of investments you can claim, but when you sell, the gross proceeds from selling the investments would be subject to tax. Okay, so it's almost a normal tax count, right? It's almost a normal tax count, right? So all the premiums that you receive subject to tax, all the when you sell your investments, you have to bring to tax, right? And then your income, depending on what the income is, right? Interest income, dividend income, rental income, depending on what the income is, right? Dividend income from a Malaysian company received is not subject to tax, okay? And my cost of investment realized, right? And my management fees can claim, commissions some can claim, head office expenses can, claims incurred can, okay? Cap allowances also can, normal tax count, right? Losses brought forward also in claim, right? And your tax rate, ladies and gents, is 24%, right? Your corporate tax rate, your share cap is definitely going to be more than 2.5 million. You cannot escape. It'll be subject to the maximum rate of 24%, okay? But ladies and gents, there's something very unique for the general insurance business, okay? So I'm going to introduce you to a word called the reserve fund for you unexpired risk. Okay, so it's basically an assessment of the risk. Okay, so what happens if all your insurance policies for your cars that the vehicles that you've insured, the buildings, right? Can you imagine we get a contract to insure a plane, ladies and gents, right? Can you imagine, let's say, for example, now you want to go for a holiday, right? And you pay 18 ringgit. Let's say you're going to go to New Zealand, right? You've got to go to Australia. You've got to go to Thailand and you make an insurance, right? Now, if nothing happens, the insurance company will take the money and put it in their pockets, right? But ladies and gentlemen, there is a huge risk, right? If something happens, right? Let's say, for example, the building that we insured, right? The office tower in Sunway was insured and something happens to it, then the payout is going to be right huge. So if it's a 50,000 ringgit that we are receiving, say 18,000 and the 50,000 payout, and if the damages are say 40,000, we have to pay a huge amount. Okay, so there's a huge risk in the insurance business. So because they take a huge risk, there's a reward. There's a tendency of making huge money, but there's a huge risk, right? There's a huge, especially the motor vehicles in Malaysia has a very bad record because the accident rates are actually quite high. So that's why they always review it to see, how best to manage, because they don't tend to make a lot of money from the motor vehicles, but all the others, they tend to make a lot of money. Okay, so let's look at this unexpired risk. I'll just call it as UPR. Okay, now this UPR, right, is actually got two types, right? There are two types, right? There are two policies. One is called the I'll just copy it here. I think this is a missing word here. There's something called the MAT policies. Okay. Now, these MAT policies are marine, aviation, and transit policies. Okay. Marine, aviation, and transit policies. Okay. And all the others, which are not MAT, would be like, for example, motor insurance, your fire insurance for buildings, right? All that will be covered under the others. But for us, what we have is there are two categories called marine, aviation, and transit policies. Okay. So let's say, for example, now we're getting a contract to insure a plane, right? For say 15,000. And now let's say, for example, now we don't want to take 100% of the risk. Okay, so under the insurance business, there are some companies who actually like to reinsure, right? They're in the business of you'll see this. There's a company called Swiss Re. Swiss Re is in the business of reinsuring. So they'll come to you and say, "Hey, you want or not? I understand you have a plane. You have insured a plane now with Malaysian Airlines. Okay, we will take 10%, right? So when we are now taking the risk, right, that reinsurance, our insurance company will have to make a payout. Okay, so that payments for reinsurance premiums, right? Let's say, for example, now I'm giving it to one company in Malaysia, right? Let's say, for example, Zurich MAA Insurance, right, Bahad, and let's say, for example, I'm actually making 5,000 payments to them because I'm going to share the risk, right? Remember, I received the 15,000. So if I want to share the risk with somebody else, I have to pay out. So reinsurance is a payment, right? Because I'm going to go to another insurance company and say, "Hey, you want 10% or not? You want 20% or not? You want 50% or not?" Okay. So when I'm making a payment of insurance premiums to a company inside Malaysia, I can claim 100%. Okay. If you're going to give a reinsurance payment or make a payment of reinsurance premiums to a company in Malaysia, right, you can claim 100%. But ladies and gents, if you pay insurance premiums to a company that does not have any business in Malaysia, that case, you can only claim 95% of the amount you paid. Okay, so if you have paid 3,000, you can only claim 2,850. Okay. Now the Malaysian government is not forcing you to only do business with Malaysian companies. They are saying it's up to you. But if you give it to, for example, Swiss Re, or you give it to one of the largest companies in the world, right? One of the largest insurance companies in the world is Lloyd's. Lloyd's of UK is one of the oldest, right, insurance companies, and is one of the largest, right? Together with AIA, Prudential's, right? We have MetLife and all that's very big, but Tokyo Marine is also very huge. But we have if you make a payment, you can claim only 95%. Okay, so I take the gross premiums receivable minus the reinsurance premiums that are paid out. I arrive at something called a net premium, and this 25% rate, ladies and gents, it's fixed in the Act, in the Income Tax Act for insurance industry for MAT policies. It's 25% of the net, and this reserve fund is known as the closing UPR for that YA. Okay. Now, this closing UPR, ladies and gents, this closing balance for MAT policies has to be deducted. Has to be a deduction. Excuse me. Okay. But what happens, right? Of the previous year's closing becomes an opening. The opening balance that you brought forward for tax purposes, you have to add back. So it's very simple, okay? Very simple. Okay, let's go at it one second. So I go to MAT policies and non-MAT policies. I take my gross premiums receivable and I minus any reinsurance payments I made for those policies. So let's say, for example, I paid Malaysian company 5,000. I can claim the full amount. Okay? But if you paid 3,000 to a company outside of Malaysia for reinsurance, then you can only claim only 95%. Okay. Then you arrive at this 15 minus these costs. You arrive at your net premiums. Take 25%, and this closing balance, ladies and gents, is to be deducted in arriving at the adjusted income. But the last year's brought forward, you need to add. Okay, ladies and gents. Now, let us say, for example, we have something called the non-MAT policies, ladies and gents. They have decided, right? The income tax rules have actually decided. Those days we had to recalculate, right? But now we need to recalculate only for MAT policies. For the non-MAT policies, Tapa, you just basically accept the amount that is the closing balance calculated by the insurance regulators, right? That's based on the insurance regulators calculation, and the IRB will accept non-MAT policies. You don't have to recall, right? So if there's a closing balance, you go and minus. Okay, so the closing UPR for MAT policies you minus, and closing balance for non-MAT policies that's given to you and you don't have to recalculate, you minus. Okay, but don't forget, the last year's brought forward, you have to add back for tax purposes. So it goes on like this, right? It goes on like this, okay? Okay, now, ladies and gents, right? Let me finish up with this so we don't have to come back to this anymore, okay? Now, ladies and gents, now here, there are some terminologies that we're going to be looking at. So we saw life fund and shareholders funds, right? We have life fund and shareholders funds. We have life fund and shareholders funds. I'm just trying to look for an annotation to see how to, I think there are some annotations available, right? Like I just want to put a pointer there and all that. So is it possible here? Do you know where it is?
What do you mean annotation?
You see, I want to go to this document, right? This page, and I want to actually highlight certain things. I want to put a pointer. I'm talking about this point side. You see this mouse point here. So normally what we do is, I'm just referring to Zoom, but normally in Zoom what we do is there's a sign there. There's a huge sign there. Hey, I'm referring to this, and there's an annotation there, or there's an highlight, and normally it's actually available in the system, your application, but I just don't know where it is.
Since you're using Microsoft Word, maybe you can use the comments,
but that's fine. Then it's normal. Yeah, then it's back to fine. Okay. So now, okay. So I'm just trying to refer. Now I'm referring to life insurance. So we know life insurance include life fund and shareholders funds. But if there's any life reinsurance business, right, and that will be treated as general insurance. So there's one unique treatment for life reinsurance business that is given in your book. So I just want to just highlight to you that life insurance business is treated as general insurance. And general insurance includes marine, right? Fire, accident, motor, huge, right? Engineering, aviation, right? Shipping, massive, shipping, burglaries, right? And public liability insurance. But ladies and gents, there was one type of incentive given to us, but from 2019 it was deleted by the government. So they wanted Malaysian companies to go and insure risks outside of Malaysia, right? So let's say, for example, the Al Burj Khalifa towers in Dubai, right? Let's assume that our Malaysian company, right, we decided to go overseas, expand, right? Let's say Sydney Harbour, we get the contract to what we call to insure the Sydney Harbour Bridge. Well, that is just amazing, right? Remember, we were a small insurance company just doing within ourselves from life, then suddenly we went to general, and now we're basically going overseas, right? We're insuring, right? But the Malaysian government was encouraging Malaysian companies to go and insure risk. But it's not easy. It is not easy, right? It's very challenging, as you know, right? It's high risk, right? And so there are so many players, right? But if you do it, then that would be called an offshore insurance. Okay, so that would be called an offshore insurance. So where the risk is outside of Malaysia, and you get the contract, and that was only subject to tax at 5%. Okay, that was subject to tax at 5%. So the gross income from offshore business, and let's say, for example, now we didn't get the contract for Sydney Tower. Let's say the Lloyd's UK got the contract from Sydney Harbour Bridge, and then Lloyd's called us and say, hey, you want to know, I give you 10% lah, right? Since you gave me last time, you want to not? You want to take 10% share or not? Okay, so if I want to take, means they have to pay me. So that inward reinsurance, ladies and gents, that inward reinsurance, right? That inward reinsurance, because we are reinsuring now. So that inward reinsurance and offshore insurance was subject to tax at only 5%, right? Not even at 8%, it is 5%. Ladies and gents, they have actually decided to rationalize, and they deleted that 5%. It's no longer applicable for us. Okay, no longer applicable to us. Now, before you go to your book, I want to go to this question. Okay. Now, let us say we just take general. We don't talk about offshore because the offshore is deleted, right? So we don't have to spend time on offshore because we don't have the incentive anymore. Okay. Now look at the general fund. Okay. So we have gross premiums. Okay. And then they give you a note. Note 1 says M A T. M A T. Okay. So they gave you the gross premiums of 5. They paid reinsurance premiums to an insurer inside Malaysia, 3 million. And they also paid reinsurance premiums payable to insurers out of Malaysia, 500,000. Okay. Now, what does it mean? It means, right, for the reinsurance payments, you can claim, but depending on who you pay. If you pay to a Malaysian company, right, you can take the gross premiums and minus the 3 million in full. But if you pay reinsurance payable to a insurer outside of Malaysia, ladies and gents, how many percent you can claim?
95.
95. Hey, very good. Okay, very good. And then you arrive at the net premiums, and that formula of MAT actually has a 25% of net premiums. And that closing UPR, ladies and gents, you have to deduct, right? Deduct. Okay. Now, don't forget, ladies and gents, there's another point here you got to you need to remember is for the reinsurance premiums that you're paying, you can claim a deduction for it. So in arriving at the adjusted income for your general insurance, the reinsurance premiums that because here you're actually declaring in full, can. So when you're making the payments for reinsurance premiums, you can claim the reinsurance you paid to a Malaysian company in full. But if you're paying it to a reinsurance payments payable to outside of Malaysia, then you can claim only 95%. Okay. So there'll be 2 adjustments required for reinsurance premiums. Okay. So we'll come to that in a minute. Okay. But now, if I was to go to that question, Now, for the non-MAT policies, ladies and gents, right? So if you look at the closing UPR here, they gave you a note, right? See this closing, the reserve fund for unexpired risk. So your accounting year is 31st December 2017. So it's given as 5 million, and they say that the closing balance includes non-MAT policy of 2 million, right? Non-MAT policy of 2 million. Okay, and then the brought forward closing UPR is given to you at 1.8 million, and is given to you at 1.8 million, and they have general insurance has got a cap balance of 120,000. Okay. Okay. So before we do that question, ladies and gents, now if you read the if you read the chapter, right, it is much straightforward. Okay, it's slightly straightforward because the insurance industry is one of those chapters where it's got so many different type of words. It's a different concept. It's not like a manufacturing company, it's a bit so insurance companies is actually covered under Section 60 of the Act. Okay, so Section 60 covers the rules relating to the special industry or the specialized industry of insurance, right? And basically, we are dealing with 4 ASOCs. Everything that they do is all from business, and they, ladies and gents, are taxed on an insurance company, right? A resident insurance company, ladies and gents, a resident insurance company is subject to tax on a world income basis. Okay, so the BISA includes insurance, BISA. Okay, so resident insurance companies will be taxed on the income derived from worldwide operations. So if they have a branch in London, then the London branch profits would be subject to tax on an accrual basis, and of course you can get a tax credit for the the bilateral tax credit for the taxes suffered in that foreign jurisdiction, depending on the double taxation agreements available to you. Okay, but non-residents, no, you only pay tax on what is derived in Malaysia. We have a few non-resident insurance companies in Malaysia also, although the Malaysian government is actually encouraging you to set up a insurance company in Malaysia, but there are some, right? In fact, most of the the insurance companies, ladies and gentlemen, like for example, Great Eastern was operating as a non-resident, right? Until one fine day, the government actually said, sorry, if you want to come to operate in Malaysia, you have to be resident. Otherwise, sorry, we cannot entertain you anymore. So all of them actually became resident companies. They set up a company in Malaysia. They set up their management and control in Malaysia. So everything is now, the whole Great Easterns, Allianz, right? All those giant AIG, AIA. Remember the AIG, AIA, Prudential is huge, right? So all that are local companies now, right? Local companies. They're what we call resident companies. Okay. Now the types of insurance business. Yeah. So we have the life insurance business and the general insurance business. Yes. So the main 2 classifications is life. Okay. So categories of insurance. So we have life insurance and then life reinsurance is like, for example, say Tun Mahadis, right? Contract insurance, life insurance. Let's say, for example, Great Eastern gets a contract, right? Let's say the premium is say 100,000, and say, for example, now they want to share it with our Malaysian company, right? So that would be a life reinsurance, okay, reinsurance business. General insurance and what we call your motor, your aviation, right? Your buildings, right? Inward reinsurance, right? Inward reinsurance and the offshore insurance, ladies and gentlemen. Remember, we discussed, the Al Burj and the Sydney Harbour Bridge, right? But that has been deleted from 2019, right? So that 5% has been deleted, okay? Yes, so we have a policy, right? We have a contract. Sometimes they call it policies and contracts, right? And it includes all those that we discussed: life insurance, right? General insurance, right? So here, ladies and gents, under the fund concept, we have this income of an insurer could consider the following: income from insurance activities and income from shareholders' funds. Now, when this word shareholder comes into place, I think you've actually heard this word. Okay, you've heard this word called shareholders' funds. Okay. Okay. Now here, ladies and gents, I want you to take your highlighter a bit. Okay, your highlighter. Okay, so here the information. Now here, this is what we call a critical information, right? Critical information, because it's got certain rates. Okay. because it has got some old information and new information, right? They have not distinguished it, right? If they had actually put the new information in a bold and the old information is not in bold, then I would have told you whatever is in bold is new. But they decided to retain both the old and the new, and they did not distinguish. Okay, so here you need to do the distinguishing. You need to come up with the highlighter, and then you need to highlight. Okay, now for the life and takaful insurance, right? Life insurance, it is 8%. Okay, it is 8%, but that is only applicable for the life fund, not for the shareholders funds. Okay, now for the shareholders funds, ladies and gents, it is 24%. Okay, so it would have been much better if they had written 24% first and then put the 25% until 2015, but they didn't do that. So you need to make sure. So when you're answering the question, or when you're picking up the rate, you must make sure you pick up the right rate. Okay, otherwise you lose that mark that is allocated. Now, as you know, Malaysia is actually being encouraged, right? We are trying to be the international Islamic financial center globally, right? And we are doing extremely well, but we have a lot of competition, right? UK is fighting to get a piece of the share of the market, and Middle East, right? I mean, Dubai, as you know, is very, very, right, very aggressive, and they, right. So but despite that, ladies and gents, I'm very happy to inform you that, as you know, that Malaysia is a leading, right? A leading, is in fact one of the top for international Islamic financing. But that is because of these reasons. It's not simple, huh? So for takaful companies, ladies and gents, right? Companies and takaful units licensed under the Takaful Act are given 100% exemption for 10 years. Okay, so if they set up a takaful company, they were given a tax holiday for 10 years until 2016. And then for those, what we call as ICBU, International Currency Business Unit, ICBU, that's operated in Islamic banking or takaful activities, right? But it is transacted in foreign currencies, 100% exemption. 100% exemption. Okay, 100% exemption. And then for conventional and Islamic, right, under the Islamic banks and under the Islamic Financial Services Act, right, and also 100% operating under the. But it is actually relating. But you can deal with Malaysian residents. Okay, so you can deal, but you still need to deal with in foreign currencies. But you can also deal with Malaysian. They're allowing you to deal with Malaysian residents. Okay, and this incentive was actually recently extended to 2020. Okay, so this is still in force. Okay, now we move from the life to the general insurance. Now the general insurance is not 25; it's actually 24. So you need to highlight this. Okay. Now, ladies and gents, remember I will introduce you to two words. One is called the offshore insurance, and the other one is called the inward reinsurance. That means the risk is outside of Malaysia, and but that, ladies and gents, has been deleted. Okay, that hasn't been deleted. Right? So the 5% has been deleted from 2019, right? And the tax rate is 8% on income from reinsurance business. So the reinsurance business, ladies and gents, under the general insurance, we also have a reinsurance business. Reinsurance, what is reinsurance? I don't get the contract from KLCC, right? I don't get the contract because I'm not that big. Let's say, for example, Zurich gets the contract and then they give it to us. Then in that case, it becomes reinsurance business, okay? So they've removed the offshore insurance and inward reinsurance. Okay. Now we go into life reinsurance, and let us look at the format, okay? So in your tax computation, right, you have to separate the life insurance business into life fund, and that one is called the shareholders funds, okay? And then you take the gross income and minus any allowable expenses. So the format of the tax norm is, now technically speaking, you can take PBT, but it'll be much easier if you do it this way, because the information is actually given to you in such a way, right? It's not like, you remember the corporate tax question, they give you this whole bunch of, provisions, and then this analysis of entertainment expenses and all that. It's not that sophisticated. It's not that sophisticated here, not that detailed over here. So you don't need to do that. So you take all the income that's subject to tax. Okay. So So your return on investments, right? Your dividend income, your interest income that is subject to tax, bring it inside, right? Gross proceeds from selling your investment. But ladies and gents, you do not bring in gross premiums from issuing policies. You do not. Okay? You do not. Okay? Now, if you have any actuarial surplus, ladies and gents, you add to the shareholders fund. You add. Okay? It's plus. Then you can claim allowable expenses. So your cost of your buying your investments, cost of selling the investments, right? Actual deficits you can minus. Okay, but that is only applicable here, huh? Right? That is so you minus from here, then arrive at adjusted income. Now here, ladies and gentlemen, there's a typo error. Okay, so this is supposed to be here. So you've got to take minus, delete this, and paste it here. Okay, so under CA is only given for life fund, huh? Not for shareholders fund. So this is a typo error here. So just make the amendments. Okay, so delete this and put it inside here. Okay, and then I arrive at my statutory income, and then I claim my donations, right, and arrive at my chargeable income, right, and I'll be taxed at 8% over here. Okay, 8%. Now that has been rectified. Now here there's for because you're receiving certain exemptions, right? So like a single tier dividends is now exempted. There was certain adjustments you had to make because of this adjustment for this actual. But what you do is when you get shareholders funds, you just put in the actual surplus over there, right? Now if you look at this non-resident, here it is correctly shown. Okay, so the gross income will be income from investments made out of insurance Malaysia Life Fund, right? Investments or return investments, your dividends, interest, right? So the gross proceeds from investments arising from investments, all right? So that means when you sell the investments, you got to bring in the gross proceeds, and also actuarial surplus has to be taxed here. And then allowable expenses, cost of acquiring this, the investments you can claim, right? And then your actual deficit you minus, and then the capital allowances is only available for the life fund. And here it is correctly typed. So there's no error here. Okay, and then our chargeable income, there's an 8%. Okay, now one point that you need to understand is when you have a adjusted loss for the life fund, you cannot claim against any other types because the tax rate for life fund is 8%. So you cannot take the loss. What you do is you carry forward to the following year, right? Carry forward to the following year and then claim only against the life fund. Okay. Now, life reinsurance business, right? Life reinsurance business is treated as a general insurance business. Life reinsurance is treated as a general insurance. Okay, so life reinsurance, right, and inward life is treated as a general. Remember, general insurance is a normal tax. Okay, now, ladies and gentlemen, I'd like you to do me a favor, okay? Now, I want you to do the tax com for the life and shareholders fund. I want you to do the tax com for Now, I would like every one of you, right, or each and every one of you to make an attempt. Okay. So let me give it a shot. I don't know. Let me just try and see how. Okay. So the question says, right, we have life fund and the shareholders funds given to us, right? And then we have what we call certain details for each specific life fund and shareholders funds. And also there is some information pertaining such as cap allowances for the life insurance business, for the life fund. And then the dividend income note also is relevant for the life insurance, but all the others are general insurance. Okay, so you don't have to worry about that. Note 1 is general, so it's not applicable to us at the moment. We need to do that later. Now, ladies and gentlemen, I want you to tell me what is the chargeable income for the life fund and shareholders funds. What is the chargeable income for the life fund and the shareholders funds? What is the chargeable income? Once you get it, please let me know.
10,500 for life fund.
And shareholders?
Shareholders is 15,000.
Okay, now don't forget you're actually quoting in millions. Okay, so if you don't write this, then you won't get the marks.
All right.
So, yeah, okay. So you need to make sure you're putting you're realizing that the question is asking you in thousands, so you're answering in thousands. Okay, so but unfortunately, if they don't see this, then they won't give you the marks. So you need to make sure. As long as you put this thousands here, you're fine. You've got the marks. Okay. Okay, so good. Now the tax rate, of course, is very unique for the life fund, right? For the life fund, it's very unique. Why? Because we have under Schedule 1 a unique rate of 8% for the life fund, and the shareholders fund is a normal tax rate of 24%. So no big deal. But for the life fund, I did not bring to tax any gross premium, so I put a dash here. But I had to bring in the taxable income, gross income from interest and rental, but my dividend income was not actually subject to tax. So that also was a dash. But in your exams, you don't have to write if it's not relevant, right? Unless they tell you it's relevant, you don't need to write it. And so, and then I had a cost of investments of 7, but I had to pay tax based on 12. And then I arrive at my adjusted income. I'm entitled to claim capital allowances given, right? And if I had brought forward a loss from life fund, I can claim it against this life fund, and then arrive at the statutory income, aggregate income, total income, chargeable income, right, of 10.15. But here, of course, you need to make sure you claim the capital allowances. So that 10.5 million did not include, the answer you gave just now did not include the capital allowances. But as we saw in the format for life fund, you can claim capital allowances under the life fund. So life fund is. So you can claim the 350 for the, so that would be 10.15 times 8, and you get 812. And for the shareholders funds, everything was exempt income. The returns were, dividends was exempt, single tier, not from overseas. So therefore you don't have to pay tax on it. But the life fund actual surplus, you just simply bring to tax. You don't have to minus here, just simply bring to tax. You don't have any deductions available, so it's 24% flat, and you get the appropriate marks for these two. Ladies and gents, so you get the concept, okay? This is basically what we're dealing with is a concept, okay? Now, may I ask you, before I go into the general insurance, is there any questions? Wonderful.
Sir,
Yes, please.
the dividend income is exempted, right? So in the answer, should we write dividend income exempt? Or
In your
just
MICP examinations, you have to look at the note. Okay, so for MICPA, right? MICPA exams, right? Some examination bodies actually force you to write, right? But not for MICPA. What they do is, like you look at the corporate tax question, they don't have a note saying that for nil items you need to write. Okay, so in this case also, for nil items you do not have to write. You do not have to write. Okay, the only thing is they have actually just documented this gross premiums as nil. If you notice the gross premium. So if you can just do that for the exams and don't write for the others, that's fine. So in your exam answers for the life fund, the gross premiums you write that kosong or not, is dash, gross premiums kosong dash. Then all the others you don't have to waste time writing. You don't have to. Okay, you don't have to.
Is it the same for question on corporate tax? That means items that are not deductible, they are deductible, for example. So the answer is nil.
Zero. None. Don't waste your time.
Okay.
Complete waste of time. It's a complete waste of time. But let's say, for example, now you went in, made an attempt to write. Let's say, for example, in this case, it was not supposed to be that. Let's say it was a staff entertainment. Okay, but when you what you did was you added. See, that staff entertainment is not deductible. Actually, you don't have to write, but you went and treated it as a non-deductible, so you went and added. So what happens is you will lose the mark. You will lose the mark because you will be given the marks for getting this answer correct. But because you got this answer wrong, you will not be able to get the mark for this. So you will lose out on that. The reason, so how you're going to lose the mark is for writing something that is not supposed to be there. You write there staff entertainment, you add 36,000. No, there's no impact of there. You will not be penalized. But when it comes to giving you an answer, mark for this correct answer, you will not get the mark because you did a wrong adjustment. But you do not have to write nil adjustments in your answers. It's a complete waste of time. Okay, but sometimes the examiner also is testing you whether you know or not, right? So they've decided not to ask you to write. But actually, the other examinations like MIA and all that, ACC and all that, you have to write the staff entertainment nil, right, and then only you get the marks, which is actually quite a tough job actually because you write a lot.
Yeah, that's our practice at the university too. All the nil items.
Yeah, exactly. See, your exam, your practice in your. But I think you have a note in the question, Doctor.
Yeah, we put note in the question.
So that is clear. You have to write it, so no choice. So that one is not required for MICPA, right? So you will not be getting the marks. Okay. So now let me actually quickly move on to general insurance. Okay. So general insurance here, like
Mr. Ravi, before you move on, I just want to confirm in the study guide page 5 for the insurance business in the format under 6.2.
Yes, please.
The actual actuarial deficit under the allowable expenses. You have to deduct under shareholders fund. Do we have to deduct under life fund? Is that
no, we don't.
In previous page 5, under 6.2.
What we do is we don't actually deduct from your. We don't deduct and put it inside here
because the formulas they deduct. So
so you deduct from here,
but
you don't deduct from here.
Okay, all right. Just to confirm
Don't
that.
deduct. Okay. Just like what we saw in the format here, right? If you look at the past year Q&As, it actually has a format whereby you don't make any adjustment on the life fund, right? So let's say, for example, you have a surplus here. Technically speaking, what you're doing is you're supposed to take it from somewhere, right? So you don't have to minus it from here. Okay. So what we're doing is we're basically following the format for MICP exams, okay? Because it's actually something very unique, right? Very specialized. So we have to rely on the examiner's treatment in this case. So in this case, we will follow his treatment. Okay. He seems to be consistent in this, so we'll follow that.
All right.
Okay, but now let me actually just quickly wrap up with general insurance so that we can move on to the next areas. Okay, so general insurance, ladies and gents, is there's an error there. I just want to highlight the error. That's why I wanted to go to this in some detail. There's an error inside this note, so I just want to highlight that. Okay, so general insurance, all right, is under 60 sub 5, right? No problem. No problem. Here it is. Gross premiums from policies issued for your buildings, for your vehicles, your aviations, your whatever transit, right? And any other gross income from commissions, receivable interest, dividends, depending on what it is, right? Gross provision selling your investments, right? Amount recoverable under any reinsurance contracts, right? But ladies and gents, your opening balance for UPR. Now, what is UPR? We don't know what is UPR, right? We have no idea what is UPR, right? So reserve fund for unexpired risk. So there's a formula that we have to see whether it is given inside a book, okay? But if you have an opening balance that's given to you in the exam question, you add back as part of your gross income subject to tax for general only, okay? General insurance, okay? Now, allowable expenses, no problem. Your management fees, your claims, right? Your reinsurance premiums that you paid, right? But it depends on who you paid. If you pay to somebody inside Malaysia, you can claim 100%. If you pay to somebody outside of Malaysia, you, in fact, told me it is 95%. Commissions, right? Your management fees, as long as you make sure it doesn't include any depreciation and all those funny things which you're not supposed to claim, only allowable expenses, management fees you can claim, okay? But here, ladies and gents, the closing balance for UPR, you can deduct in arriving at the adjusted income. Okay, so your cost of buying the investments that you bought in Sabura for 100,000 you can claim, but when you sold it for 120,000, you need to bring it to tax. Okay, arrive at the adjusted income, right? You can claim capital allowances, right? But let us now focus on the UPR. Okay, now this 60 sub 9, the way it's written, ladies and gents, is written by a lawyer. It's not written by an accountant, because accountants wouldn't have written so many words. But legally speaking, you need to include all these words, all right? Otherwise, it will not be covering. So what they write is 25% of the difference between the gross. Oh my God, OMG, like what we say. So what we have done is we have gone and summarized it in this version. So there's a company called May Insurance Company, Sindang Bahad, right? And they have two categories. One is called an MAT policy, right? And non-MAT, right? MAT policy and non-MAT. Okay. So for the MAT policies, I take the gross premium. Sorry, this is the gross premium. This is right. I think it's been moved. So the column is the 800 is there. Okay. So I paid to a local company. How much I paid? I paid like 100. If I pay 100,000, I can claim 100,000. If I pay 100,000 up to local, right? Insurance companies inside Malaysia, I can claim 100%. So if I pay 100,000, I can claim 100,000. But I didn't claim it. I didn't pay, so I didn't claim anything. But if I paid to a foreign outward reinsurance company, then out of this 400,000, for tax purposes, we cannot accept. We will reduce it by 5%. Okay, and then we only can minus 95% against your gross premiums. So therefore, this 420, ladies and gents, the typo error is here. It is not 24%, it is 25%. They thought it's a corporate tax rate, and when it changed, it's actually not correct. So here I wanted to take not 24, it's 25. If it's 25%, then it becomes 105. So you got to change these two. So you got to change this, you got to change this, and you got to change this. Is that understood? So it becomes, I think, a 105, right? They've done an arrow there. There's an arrow there. Okay. Now, so this balance, closing balance, is 105. You go and deduct in arriving at the adjusted income for general insurance, right? Now, this non-MAT policies, ladies and gents, this closing balance of UP of 496, right, is the amount that is determined by the relevant insurance regulatory authority and is acceptable. So you go and minus from your general insurance. Okay, you can minus the non-MAT policies without main insurance. Those days we had to take a 40% of net. Those days, but now we don't have to do it anymore. So for your exams, you take the closing balance given to you and minus. Okay. Now on this point, is there any question? Okay. Okay, very good, huh? Good, okay. Now for reinsurance premiums payable, ladies and gents, there's one special treatment given under section 67, right? For reinsurance payable. Let's say, for example, you're a non-resident company in non-resident. So let's say Z Limited is a non-resident insurer, carries on insurance activities, right? And they actually got the business of securing a 40-story building in KL, right? And the sum insured is 500 million and the annual premium is 1 million, okay? So they decided to actually now go and reinsure, because if something happens to the building, then the whole company may collapse, may go get bankrupt. So what they do is they go and give a reinsurance, okay? So the Z Insurance reinsured the risk with 3 other insurers. So they went and paid to MAA Berhad, which is now known as actually Zurich Insurance Berhad, right? The Zurich has bought over MAA, but MAA was a very successful insurance company, and they're still involved. They're still involved. So Zurich MAA, but we call it Zurich officially. So Zurich MAA Berhad is Malaysian, okay? So if you're giving it to somebody else inside Malaysia, let's say, for example, now you received 1 million and you're now paying 200,000 to a Malaysian company, you can claim 100,000 in full, 100% in full, okay? Let's say, for example, now you have this PO Labuan. Labuan is treated as within Malaysia, so you can claim 100% of the reinsurance payable to a reinsurer in Labuan. But let's say, for example, DBS Singapore is not in Malaysia. They don't have any, they don't carry out any business in Malaysia. So we paid them 100,000. We can only claim 95%. Okay. So our ZAR Assurance Limited can only claim 95%. So what they can do is they can now say, okay, for the insurance payments that I paid to Singapore, I don't want to claim anything. I want to claim 0%. Okay, I don't want to claim. I'm entitled to claim 95 can. Okay, I don't want to claim. Okay, but, okay, if something happens, right? If something happens. Now, remember, I went and asked the Singapore company, hey, you want to share the risk or not? Now, if something happens to that tower in KL, right? And when I receive that recoveries from that policy from DBS, that is not subject to tax. Okay, it's not subject to tax. Okay, see, like for example, now if you wanted to go, let's say KLCC, right, Twin Towers. Now, if KLCC Twin Towers wanted you to insure the company, insure the buildings, they have to pay us or you have to pay them. If KLCC Twin Towers wants to insure their building, the premiums, they have to pay us or you have to pay them?
They pay.
They have to pay us.
They have to pay us because we are taking the risk. Okay? But sometimes, ladies and gents, it is just too much, right? Can you guarantee what is going to happen tomorrow? If we are not able to guarantee, I don't know what's going to happen tomorrow. Okay? So therefore, that's why we like to spread our risk. So once we receive the contract from KLCC, let's say I'm getting 1 million, I'm getting 1 million, I will ask other company, hey, you want to know, I give you 10%, 20%, 50%, right? I've spread the risk. So in the event something happens to that building, I won't be suffering 100%. Can you imagine if this, I have to pay 500 billion gone case already? You know what I mean? It's high risk, high reward. Okay. Now, for non-residents, you don't have to pay tax on your income that is derived from outside of Malaysia. Whatever is derived inside Malaysia, right? So, where non-residents general insurance is wholly or partly carried out inside Malaysia, then only the income that you get from Malaysia we want to know. Otherwise, whatever is outside of Malaysia, we're not interested. Okay, and the normal tax format. Okay, they also have a closing UPR and they have an opening UPR, right? And then now for inward reinsurance, we saw inward. Remember the risk was Sydney Harbour and Al Burj Khalifat. Remember the towers? It's one of the most beautiful buildings I've ever seen in the world, right? It's so beautiful in Dubai, right? So that has been deleted, right? And now this word inward reinsurance is substituted with the word reinsurance. Okay, and if you have any business that has to be apportioned, then you segregate between reinsurance and general insurance. Reinsurance, because reinsurance is 8%. Okay, 8%. Okay, so now, ladies and gents, right? And offshore insurance also we saw earlier. Offshore insurance is it's been deleted from 2019, right? It's treated as other insurance business. Okay. And takaful, ladies and gents, is actually a conventional, right? They're mirroring the conventional insurance terminologies in business. So they've got their own. Of course, they actually got to be certain Sharia compliant, and there are certain rules specific to takafuls, right? And that is actually given. The whole explanation is actually given to you here. So you can have a look at that, right? You look at that, and then what we will do is, but it's actually unique to takaful. Okay, so I'll leave that with you, and then I will come to this case law after you finish this question. Okay, now, ladies and gents, I want you to go to this question, okay, and read the general insurance only. Don't do the offshore. Offshore, we don't have to worry. Now, now we call it as reinsurance. So we have life funds, shareholders funds, general insurance, and reinsurance. Reinsurance is actually taxed at 8%. It's called reinsurance business. Under general insurance, we have reinsurance. Reinsurance is taxed at 8%. Okay, so we don't have to do this question now. We just do this part only. Determine the chargeable income for general fund only. But I want you to do it, just write in short forms, like GP, right? INT, INC. You just do it in short forms, okay? So each line item you ask, is it taxable or not taxable? Is it deductible or non-deductible? Taxable, put it inside. Deductible, you claim, okay? But of particular importance is actually the calculation for reserve for unexpired risk, right? The UPR. And I think there's a note there. That note is actually, you need to refer to note number 4, actually. There's a note 4 here after this 500,000. You see this? In this here, there's a note 4, which is, there's a typo here. The 4 is missing. So it'll be good if you can actually do it on a landscape. Okay. So instead of doing a portrait, you can do life. That means you do just exactly like this. This is the landscape. Okay? So you do the life, LF, shareholders funds, GF, right? And if there's reinsurance business, you can show it separately. And then then you can show that. Okay. So you don't have to spend time writing dividend incomes, right? But a lot of interest income, you don't have to write it twice, right? So you've already done it earlier. So you would just write the amount is easier. Okay. So tell me, what is the chargeable income?
Can you scroll down a bit to see the capital allowance?
Okay. So now, okay, so let's go through this, okay? So here, ladies and gents, it's relatively straightforward. Most of it is straightforward, right? Your gross premiums, dividend income is single tier mean stopper, right? Foreign source income is taxable once remitted, right? So your interest income is taxable, rental income is taxable, right? Your gross profit is taxable, but you can claim the claims, you can claim the commissions, but the management fees, you got to check and see whether it's deductible or not, right? So I got to go and check and see whether it's deductible, and here it's written there is no non-deductible, so everything is allowed. So I can claim in full. My cost of selling the shares Pun Sama, I can claim. And then I have some closing balance of a UPR. But here they actually say that the closing balance is made up of two elements. So the closing UPR is made up of a non-MAT of 2 million, right? And an MAT of 3 million. So that 3 million we cannot accept. Right? The 2 million will accept because it's non-MAT. See, non-MAT we accept. So we can claim against the closing UPR, you can claim the 2 million. But for the MAT policies of 3 million, where 5 minus 2 is 3, so 3 million you cannot, you have to recompute. Okay? And then lastly, for the opening balance, what you do is the 1.8 million you add. Okay, so if I was to go here and see how the MAT is policy. Now, can you tell me what's the closing UPR? What's the closing UPR for MAT policies? What's the closing balance for UPR? What's the closing? Anybody's got it? What's the closing balance for UPR? What's the
1.525 million.
Sorry?
1.525 million.
Okay, let me just check it. Okay, tell me, how did you get that figure?
5,000 minus 3,000 and then minus 95% of 500, which is 475 million.
Yeah, and then?
And then got 1.525 million.
But is that the formula for calculating UPRs? Is that the formula to calculate UPRs? I'll ask you, I think you're not able to hear me. Is that the way to calculate closing UPRs? Is that the formula?
Yeah, gross premium minus
Gross premium,
reinsurance
very
inside
good. Minus reinsurance premiums paid, very good. right? Yes.
Um,
Then what else?
oh,
There
okay,
are two
okay,
types
okay.
of premiums. One is outside
Oh,
Malaysia and one is inside Malaysia,
yeah.
right?
And
So
then
here you have gross premiums minus outside Malaysia. Here is 95%. Then you have to take how many percent?
25%.
So did you take that?
No.
Then you can't get the answer correctly. Because the formula says you have to take only, you take the net premium, then you take 25%. Then only you'll get the, so you have to take the, so you only calculated this. You cannot take this figure. No, sorry, it's not correct. Okay. The Act says you have to take 25% of this figure, the net, and then that becomes the closing. So that case will be 381, right? So 381, that is correct, right? So 381. So 25 minus 3 minus 475 correctly at 25% is 381, plus the non-MAT of 2 million is 2381. Okay, but don't forget, ladies and gents, the opening balance, right, brought forward from last year was 1.8, so you need to add back. Then you arrive at the adjusted income, then you claim capital allowance, normal tax norm, right, and the tax rate is 24%, and your tax payable is how much. Ladies and gents, is there any questions? Okay, so here, conceptually, the treatments are depending on what you're treating. Okay. Now, for the offshore insurance, ladies and gents, now that 5% is not applicable anymore for us. Okay. So for now, they've actually now it is a reinsurance business is at 8%. That's all. So there's reinsurance business, then it is 8%. Okay. Okay. Now, ladies and gents, let me actually wrap up by that case law that I wanted to go into. Okay. Now, is this Singapore company that actually insurance company in Singapore, right? You go to page 7-19, you'll see this case called BBO. In Singapore, they don't actually write the full name of the taxpayer. They only write in short forms. They write the A, CIT versus A, or BBO, or the initials, or X, CIT versus X. They don't want everybody to know the taxpayer's name. In Malaysia, it's different. They don't mind. It doesn't matter whether it is the taxpayer's name is actually normally published. Okay, so in Singapore, this insurance company, when it had some gains on investments, okay, so the revenue authorities actually said, no, since your inventory and stock in trade is cash, whatever you do with the cash is business income. Okay? But this company argued, no, we also can have investments, and investments is capital. Capital gain is not subject to income tax. Only revenue gain is subject to income tax. Ladies and gentlemen, this company actually argued against the controller of income tax, the so-called Director General of Income Tax in Malaysia, but the controller of income tax, right? Controller, right, of income tax in Singapore. And they argued. They said, no, it is revenue, must be taxed. Okay. So the Court of Appeal, ladies and gents, right? So the Court of Appeal, so they appealed to the High Court, right? So they actually went and appealed to the High Court, and they actually said that the Income Tax Board review, right? The controller issued a notice of refusal, and taxpayer filed notice of appeal against assessments against the Board of Review, or what we know as Special Commissioners of Income Tax in Malaysia, and allowed the appeals. So they said the taxpayer was correct. It is not revenue; it is capital. So the controller said, no, I don't agree with this decision. So let's go to High Court. So the High Court actually agreed with the Board of Review, right? The BOR, right? The ITBOR, and they said it is capital. It's not subject to tax. So an insurance company can have capital, right? Investments that relates to capital, and not everything has to be revenue. Okay. And this controller eventually landed up and agreed with the Court of Appeal, which we also can do in Malaysia. And the Court of Appeal actually said that the High Court was correct, right? The decision held as shares were capital, right? But in Malaysia, it's going to be a big problem, because I don't think so IRB is going to accept that argument, right? So that is what happened in this case. Okay. Okay. Now, ladies and gents, now since we are here, why don't you actually just have a 3-minute washroom break, and then we'll continue at 10:10. Okay. So you can just get your drinks or whatever it is, and then we start at 10:10, and then we'll continue with banking, and then we'll go on to the others. Okay. So I'll see you guys at 10:10.
Mr. Ravi,
Yes, doctor.
can I ask about the case law just now? Because
Sure,
that case
please,
is in
yes.
Singapore, so it is not binding in Malaysia, right? I just want to know.
It's not binding. No, it's not binding. But although you can use it as an argument.
Mm.
You can argue. You can say, look, in Singapore they did this. These are the reasons, and Malaysia also is similar. So we can argue, but it is not binding. You don't have to follow the law. You're absolutely correct.
Okay. I just want to know how much of in MIPA exam. How
sorry?
often do in MIPA exam? How often do the candidates have to refer to case law?
Okay, we do refer to case law. We do refer to case law. There will be questions based on case law. Okay, and that one is actually on question number 2. So if you go to question number 2, that is one section specifically catered, right? So if you go to question number 2, let's say, for example, the company is making a gain, or they're incurring some expenses. Those kind of questions, like for example, stock and trade. Withdrawal of stock and trade. Remember the Mercedes, Sharkey and Werner and Mercedes-Benz case? Those cases, right? So this would be about approximately 5 to 10 marks in the exam question. So these questions would normally involve case laws. Like for example, the badges of trade, right? The gain is.
So it's a must.
If they ask you a question that is involving a case law, you will get marks for quoting the case law. But you will not lose marks for not quoting the case law, right? But you will get marks for quoting the case law. They're looking at the arguments. Like, for example, in this say, what are the arguments for the expenses to be deductible and what are the arguments against? So they'll give you marks for writing the arguments. And then if you write the case laws to support your views based on the principle of that case, then you will get more marks. But normally for
if the name of the case is not mentioned,
they will not ask you a question here. But to address your question, whether you
your voice is breaking,
like in question number 3A, will they ask you what is the case law that happened in Singapore? The answer is no. They won't ask you about that.
Okay. So just the question on the of trade and also the activity of expenses.
Yeah, so taxability of gains, deductibility of expenses, whether you can claim capital allowances on a plant, like you remember the Tropiland case, the Yamaha plant. That would be actually very relevant for your question number 2, CAs. Okay, I can't actually hear you well. I don't know why, doctor, but that's why I have to move my my screen because I can't hear you well. I think, are you using your headphones? You are, right?
Yeah, I'm using my headphone, but
okay.
I don't know whether it's your internet connection or my internet connection, but your voice was breaking just now. It's okay. Okay, let's go to the break. For the break, we'll come back. Okay, thank you.
Okay, so ladies and gents, now we shall go to the wonderful world of, right? Not Disney, but banks. So ladies and gents, once you start working, right? Let's say you're working in a bank. Let's say you're working in a accounting firm, right? Let's say you're working in a company, right? You also will be working hard for the bank because once you receive a salary, the banks will be waiting for you because you would have taken a housing loan or a car loan. So let's say you're getting 5,000. You got to make sure you pay installments for buying the house and your car, right? So banking is very important for us. But ladies and gents, everything is going to be whatever they receive. Their inventory is cash. So whatever they do with the cash, you try to argue that it's not subject to tax because it's capital, right? I don't think so we'll be succeeding. So there's one case law here that we're going to spend a little bit of time. But otherwise, ladies and gents, this banking is very straightforward, right? All the income that is relating to your business is subject to tax, right? You are taxed on a world income scope, just like insurance company, right? BISA, right? Shipping and airline. Resident banks are subject to tax on a worldwide scope. But non-residents, we also have non-resident. We have, I think, one company from one bank from India, and there's another major bank from China that is operating as a non-resident. But otherwise, mostly all of them are residents. In fact, the Citibank was actually operating as a non-resident, right? Citibanks, right? All those foreign banks were actually operating. But then one day, the Malaysian government said, sorry, if you want to continue doing business in Malaysia, you have to be resident. So they became Sindian Berhad and then Berhads. So they all are mostly resident, but we also have some non-residents, some huge banks from India and China and Europe and the US. Okay, so here we have residents and non-residents, right? Now also, of course, as you know, we are trying to promote Labuan as an international financial center, right? A business financial center, IBFC. So we've actually got various acts like the Labata, right, Act, and is promoted. Okay. Now, one thing, ladies and gents, the Malaysian government decided to do sometime in the late 2000s was they wanted Malaysian companies, banks like CIMB and Maybank to go outside of Malaysia. Don't just focus on Malaysia. Okay. So they gave them tax incentives. Okay. They gave them tax incentives. That means the profits of a newly established branch overseas, right, remittance of income by overseas investing companies, will be given tax exemption for 5 years. Okay. Now, CIMB, ladies and gents, and MI and Maybank are doing extremely well in Singapore, right? They are doing well in Thailand, right? And so in Southeast Asia, they're doing relatively well, and that's because of this initiative given by the government. Okay, so they went and said, why didn't you set up Islamic banking operations? We have experts in it. Why didn't you go to Singapore's and so we do extremely well. But that application, ladies and gents, came to an end on 31st December 2015. And so Bank Negara decided to stop. They did not want to extend it further from 31st December 2015. So today, you will not be able to enjoy that exemption. So there were certain criteria and conditions to meet, but it is so it is not available now. Okay, but on the other hand, like you already know, Islamic banks and Islamic banking units, right, are given a 10-year tax exemption on income derived from Islamic banking business conducted in international currencies and also conducting with Malaysian residents. Okay, you saw that earlier also. Okay, now for interest, ladies and gents, right, let's say for example now Bill Gates, right, he's a non-resident, right, so he comes and invests in a Maybank, he puts FD, right? And then you go and tell him, hey, sorry, sir, you put in 1 million, your interest is 1,000, I have to deduct 15% because you're non-resident. Because the non-resident withholding tax rate on interest income derived by non-residents is 15% in the gross. So you go and tell him we want to deduct 15% and we will pay only the 85%. Then he'll say, no, I'm not going to come to Malaysia anymore. I'm not going to put money in my Malaysian banks. Okay. So to encourage non-residents to put money into Malaysian institutions, right? Malaysian banks, for example, is exempted from 15%. So Bill Gates will be receiving the interest income in full. Why? Because Schedule 6, Para 33 specifically gives an exemption for interest income derived by a non-resident, right? Non-resident in Malaysia is exempt, right, from withholding taxes. So this encourages the non-residents to invest in Malaysia, right? So this from 2006 they also extended to profits. So we don't call it interest in Islamic banks, right? Sharia actually doesn't recognize interest, right? They only recognize profits. So no problem. You call it profits, you call it interest, whatever it is, no problem. If a non-resident is investing, it is exempted. Okay, so we have Malaysia is actually doing extremely well, right? Extremely well. Okay, but one type of interest, ladies and gentlemen, that is not exempted is the bank's networking fund, or what we call as MNWF, right? So let's say, for example, we have this bank in Malaysia called OCBC Malaysia, right? Or OCBC KL, Okay. Now, let's say, for example, now Bank Negara is actually told OCBC, hey, your capital adequacy is not meeting the ratio, right? You have to top up by 1 more million. Okay. As you know, ladies and gents, banks are highly, highly regulated, right? You remember the crash that we had in 97, right? I mean, you may not have, you were probably not even born that time, but we had this major crash in 1997, and Malaysia actually learned a huge lesson, ladies and gents, right? We learned to be more conservative. We need to be more careful, right? So in 2009, right, we had the subprime, right? We had between 2007 and 2009, we had just major crisis starting emanating from the US, right? So it's so-called the subprime crisis. Our banks did extremely well in the world because we were very, very careful, right? The regulators were making sure that you had enough capital, right? Capital reserved, right? Untouched, right? So the depositors are not affected and the banks are not affected. So here we survived that. We learned our lessons and we survived it. But although there are a lot of abandoned projects even today, right? But nevertheless, we have actually learned our lessons, right? Now here, let's say, for example, now OCBC Malaysia requires 1 million. So they call up the HQ in Singapore and say, excuse, Singapore HQ, please give us 1 million. Okay. Of course, when we borrow, we have to pay them interest, right? So when you pay that interest, ladies and gents, this exemption doesn't apply. Okay. So this exemption doesn't apply for maintaining net working funds. Okay. So therefore, there is a withholding tax that will be applied, and you can apply the DTA rates, which you're going to learn, right? You'll be learning about double taxation agreements and DTA rates, right? In due course, and then you can claim a lower rate, but there is withholding tax on that, okay? But ladies and gents, like, for example, you are an individual, right? If you derive interest income from a bank, you are not subject to tax, right? Because they're encouraging you to go and invest, save, right? Save. Don't keep on spending, right? Save, right? So when you go and invest in a Malaysian bank and an FD, when you receive the interest income, you are an individual, right? You are not going to be subject to tax, okay? And there are many, many types of exemptions given to us under schedule. Like, for example, you look at 33A. 33A Schedule 6 gives you an income tax exemption in respect of interest paid or credited to any company not resident in Malaysia, other than interest accruing to a place of business in Malaysia for such company, in respect of securities issued by the government. Okay, so non-resident companies receiving interest income from investing in government securities, right? In respect of sukuks and debentures, right, issued in RM, but it must not be convertible. It must be unconvertible, right? Now, what is convertible loan stocks? Basically, it will be converted. Like, say, for example, now I want to borrow money, right? So I'm a borrower, right? So let's say, for example, I go to an investor and say, can you give me 5 million? I'll give you interest at 10%. Okay. So now this 5 million, now let's say I want it for 5 years. I'll redeem it after 5 years, right? After 5 years, I will give it back to you. Okay. But when it comes to convertible loan stocks, I won't be giving back the 5 million to you. I will be taking the 5 million and converting it into shares, and you will be holding shares in my company, right? So convertible loan stocks means, right? Now that is not a borrowing, right? That is basically you're going to invest in shares. The only thing is investing in as a instrument, right? As a security, but it's a convertible loan stocks. That doesn't qualify for exemption. It must be unconvertible. It cannot be convertible. It should be unconvertible, right? If it's convertible, means it's going to be converted into shares. That exemption doesn't apply for convertible loan stocks, okay? And as long as it's either approved or authorized or lodged with SC, and as long as it's unconvertible, and as long as it's sukuk or debenture issued in RM, the interest income is exempted, okay? Now, here, they decided to actually rationalize it, where, for example, now in 2017, the above tax exemption does not apply to interest paid to a company in the same group. Okay, like say, for example, now we are now issuing a bank is issuing a sukuk, right, in RM, right, is unconvertible in securities. But let's say, for example, Kuwait Finance House Malaysia is issuing it to Kuwait Finance Kuwait Finance in Kuwait. This is father, brother. This is father, son. Right? Brother, sister. No, we don't want you to go to your brother and sister. You go and sell the products to others. Right? Get investments into Malaysia from others, other investors. Right? You go to Turkey, for example. Right? Why don't you go to Turkey? Why don't you go to London? Right? London is huge, massive. Europe, right? Brussels. I mean, Belgium is amazing. Right? So the Malaysian government actually doesn't want you to go to your, hey, okay, Kuwait Finance House, Kuwait, hey, you put la money here, exempt, no withholding tax. So they decided to actually say that the withholding tax exemption does not apply if it is in the same group. Okay. So we have a lot of like Al Rajhi Bank, we have massive banks, right, from Saudi Arabia and the Middle East operating in Malaysia. Of course, even each bank, like HSBC has got an Islamic unit also. So they do very extremely well and is one of the leaders in the Islamic banking sectors. Same thing, Para 33B says income tax interest on sukuks originating from Malaysia, as long as it's unconvertible in non-RM, right? And approved, authorized, lodged with SC or approved by the Labuan Financial, it's called LAFSA, Labuan Financial Services Authority. Okay, again, right, from 2017, the above tax exemption does not apply to same group, right? So Kuwait Finance House Malaysia is usually the Kuwait Finance House in Kuwait, right? Al Rajhi Malaysia is issuing the Al Rajhi Dubai, UAE, Sharjah. No, that's not possible. Okay, it's not possible. DFI, Development Financial Institutions, right, is like SME banks, right, agro banks. So they are set up to help certain sectors, right, development financial institutions. Ladies and gents, as I'm speaking to you right now, ladies and gents, one of the biggest concerns the Malaysian government has got, right, and not only Malaysian government, ladies and gents, very sorry to inform you, every single government in the world today, every single government, not only Malaysia, right? Ladies and gents, we focus on non-performing loans, right? I have taken a loan to buy my house, right? I have to pay by a certain due date on the 7th of the following month, right? Ladies and gents, what happens if I don't have a job? Right now, see here the banks is easy. They're fixed. They are in a problem already. See, let's say for example, now I've not been paying my installments, right? Let's say I've been outstanding for say 6 months. Okay, let's say the definition under Bank Negara says you become a non-performing loan if your borrower doesn't pay you for 6 installments, right? You're outstanding for 6 months, right? Now the banks now, do they continue to charge you interest? I've not paid 6 months, right? So now, do they continue to charge me, continue to pay? No, I don't care. You're still not paid, so I'll keep on charging you interest. Now, when you keep on charging, ladies and gents, the banks will have to pay tax on it. See, when you charge interest to a borrower, right? The banker is charging interest to the borrower not paying you. So do you continue to charge interest or not? Okay, so they decided to deal with this issue, right? Who? The government, right? Remember I told you was remember the 97 crash? So in 1999, ladies and gents, in 2000, they said 50% of the amount in interest and suspense account from MPLs was not considered. So if you're charging, say, 100,000, you only need to pay tax 50,000. Although the borrower has not paid you, okay? But I think the definition, I'm not very familiar with the definition of NPLs. I think it is if it's outstanding for more than 6 months, then you become an NPL. I'm not sure. I'm not familiar with the Bank Negara rulings, but I think it is 6 months, okay? Okay. But once it's received, you have to pay tax, which is fine, which makes sense. Because if I'm receiving it from the borrower, the interest, then I will pay tax, okay? But from 2000 current year basis, they said that you can claim a full deduction, right? So therefore, you provide for it, you accrue for it in your profit or loss, and you claim a deduction as a specific provision. Okay. So this interest in suspense deemed as specific provisions under 34.2, right? In the case of bank, will be allowed a deduction for income tax. Right? And these amendments was retrospective from 2001. Okay, so this is one of the issues that banks face. Okay, and under 34, right, sub 3A, a debt which is partly irrecoverable includes all interest in respect of a loan or credit facility accrued from the date that loan or credit facility is classified as NPLs by Bank Negara guidelines. Okay, and then this is effective, right? They actually had these sections were actually amended, right? And in 2009, ladies and gents, let's say, for example, they gave a retrenched workers a moratorium. That means if you can certify and confirm that you have lost your job during that subprime crisis in 2007 and 8, then you will actually qualify for saying that they won't charge you interest. You don't have to pay the installments until a certain period of time, right? So for 1 year, you don't have to pay time, okay? So the Malaysian government keeps on looking at this, ladies and gents, as a very, very important issue on how to deal with. So you saw the recent, you must have read in the business news that there was this moratorium given to us for 3 months, right? For every borrower who's actually got a banking outstanding for certain loans, you need not pay for 3 months. So the banks did not charge you interest for 3 months. So they were actually losing money. But ladies and gents, this is a big issue in Malaysia, right? And not only in Malaysia, like I said, it is all over. It's all over. Okay. And lastly, 6B has been deleted. 6B has been deleted. Okay. But I want to finish up with this one case, and then we go on to the next topic, which is very important for us. Okay. Now, there's this case called Punjab Cooperative Bank. Is a bank based in India. So this bank actually had some investments. They made some gains in investments, right? And they sold it, and they went and said it is capital gains. Capital gains is not subject to income tax. Only revenue gain is subject to income tax. But of course, ladies and gents, who's going to say no to it? Who's going to disagree? I think the answer is the revenue authorities in India said sorry. The Commissioner of Inland Revenue said sorry, it is subject to tax, because whatever you do, your stock in trade is cash. Whatever you do with the cash is subject to income tax. Whether you go and buy properties and sell, you buy shares and sell, it is all subject to income tax because it is not a personal business, it's a 4A business source. Ladies and gents, this bank, right? This bank went up to the Privy Council. Right now in Malaysia, before the mid-80s, around the 70s, right? Because we were a Commonwealth country, right? We were allowed to go even, let's say, for example, I'm not happy with the decision of the DG, I can go to the special commissioners. Special commissioners, I can go to the High Court. High Court, I can go to the Court of Appeal, right? And those days, we could go to federal court, and also after federal court, we can go to this Privy Council. This Privy Council is actually governed in UK, okay? So leading cases, we have many cases that has landed up Malaysia, and many Malaysian cases that has landed up in Privy Council, like American Leap Lending, River Estates case, right? But ladies and gents, this Punjab, this company, right? This Punjab Cooperative Bank went and appealed right up to the Privy Council, and ladies and gents, the Privy Council held that the realization was in the normal course of business. Therefore, it is revenue in nature and not capital. And it was taxable. Okay? So the IRB is going to use this case against any taxpayer who's going to argue that it is from investments and not subject to income tax because it is capital nature. Okay? And there's another case called UN Finance Berhad also. Okay, and ladies and gents, this is some exemptions given to you, so you can have a look at it. I'll leave that with you. Okay, it's a reading with you. Okay, but now I actually want to go on to leasing, and finally, we have actually finished off with the chapters that we are supposed to have finished off earlier, right? But now we actually go into something that is a bit more relaxing. The best is chapter 10. The best chapter or the best specialized is chapter 10. So chapter 10 is very nice. But here we'll actually look into a few issues, okay? Leasing, just in case it's come out. It's not exactly a favorite for the right, but leasing is very interesting, okay? But let us just give a okay. So what I do is I just delete these two. Okay, so let's see. Okay.
Mr. Ravi,
Yes, doctor.
so for banking just now,
Yes,
there
please.
there will be no calculation question.
Well, I'm very happy to inform you that we have never had a question involving, it normally covers theory, okay? But it actually involves on the there is a banking question involving calculations, involving withholding tax, doctor.
Okay.
You know, this bilateral and unilateral credit? Bilateral.
Yeah.
Yeah, so that question actually, there was a question involving bilateral credits and unilateral credits, where they were taxing the income in Malaysia, and then there was this bilateral. So when you're doing bilateral, you'll be covering that aspect of the banking.
Oh, okay.
We will
Okay.
not be getting a question on whether the depreciation must add back.
Okay. All right. Good to know.
The examiners, for them, is too simple because they want something like this.
Okay. Okay.
Right. So for you, everything is going to be subjectized, right? You don't have premiums. You'll have your, your banking services, right? Your service charges for your banking transactions, your interest income and all that. And there's no deduction, special deduction given to them. It's a normal tax on your salaries, right? Your salaries, your rentals, right? So normal treatment. So nothing really fantastic, except maybe some exemptions. Remember, the payments to, maintain net working fund is not exempted. But for things like, the non-residents investing into Malaysian bank is exempted under para 33. And those could be one or two areas where they'll probably ask you, but those are quite straightforward. So,
Okay, good to know. Thanks,
but
Mr. Ravi.
as you know, of course, it is one of the leading, drivers in the economy, and it is extremely important for tax purposes that we have an idea how it works. But generally speaking, almost everything, even the Punjab case, the cooperative bank case, also they tried to argue that certain gains was not subject to tax because that also they lost. Case also, that would have been a good question for us, saying that, okay, can you argue that it is a revenue or capital? But the Privy Council actually decided that it was supporting the tax authorities.
Okay.
No, ladies and gentlemen, let's do this. Let's do this. Since it's already a Friday, right? So let me actually just, let me just jump. Okay, let me just jump. I go to 10 first, right? I go to 10 first, and then we come back to 9. Okay, because this one is a little bit of needs a little bit of detail, so I need to spend some time. So we'll come back to 10. We'll come back to 9 later, but let me do this first. Okay, this is something that you'll enjoy, and you like to do this type of questions. Okay, so we will do cooperative societies first. Is that okay, Doctor? Dr. Salva, is that okay?
Yeah, okay.
It's okay. Okay. So let me just go to this and now may I ask you, are you all members of any your university's cooperative society? Do you have a cooperative society in your university? Do you have a cooperative society? Are you a member of a cooperative society in your university right now? Just answer the question yes or no, please.
Cooperative society, no, I think.
You don't. Okay. So I remember I was actually teaching in USM. In USM, they have a cooperative societies operated by students, right? And they were actually running stationery shop, stationeries, and they were selling books, right? So, for example, the police have got a very successful cooperative society. I know Agro Bank has got a cooperative societies, but the Malaysian government is encouraging setting up cooperative societies. The Malaysian government encourages the setting up cooperatives. So we have a separate act for it, right? There's a 1948 act, right? It's a very old act, but the Malaysian government is encouraging cooperatives. You meet certain criteria, welcome, right? So my wife, ladies and gents, was working for Malaysian Airlines, right? And she was, they had a mass cooperative society, right? So this was basically catered for the members. Okay, so they have a restaurant, right, where they had members and non-members, right? So I also couldn't go and eat. I had to pay for the food. There used to be a boutique. So I can go into a boutique in Klanajaya Mass Academy. They had a nice boutique there, and I can buy a perfume. But when my wife, being a member, when she gets it, it's slightly cheaper, right? So she is this corporate society is created for the benefit of members, right? So they carry out businesses, like for example, they carry out a boutique, right? Duty-free goods, right, at reasonable prices. They had a restaurant, right? I remember the cooperative society, the police cooperative society in a place called Sikamat. I don't know whether you've heard of this place in Sramban, but they were actually having a cooperative societies, and they were running a farm. And it's operated by these farmers. And we used to, on the way, I used to live in Sikamat in Sramban. I used to stop by and buy this fresh, beautiful looking fresh. I can see the garden. I can see it because the cooperatives, the police actually own the land. So they were asking these farmers to operate the vegetable gardens, the farm, right? The farms, right? So they were actually carrying on businesses. And the main reason is not to carry out business, not to sell vegetables, is to do things to help members. Okay. So, for example, if you want to do studies, I want to do my PhD, I want to do my master's, I want to do my degree, you can get a loan. Maybe the interest is cheaper, right? If you do very well, then they'll give you a scholarship. Okay. So, cooperative studies, ladies and gents, were encouraged by Malaysia. And ladies and gents, they decided in para 12 of Schedule 6, for the first 5 years, it is tax exempt. Okay. Whatever income you make, your chargeable income is 100,000. Your taxes cost out for the first 5 years from the date of registration. Okay, so for the first 5 years is tax exempt. Whatever income you're doing, duty free, you're doing academy, boutique, cosmetic, whatever, books in the remember the universities, right? The books you sold books. That gain is not subject to tax. Okay. But ladies and gents, after the expiry of 5 years, then it depends on whether you are a big corporate society or a small corporate society. Okay. If you are a small corporate society, you do not have to pay tax for that year. But if you are a big corporate society, you have to pay tax. Now, what do we mean by small corporate society, ladies and gents? If your members' fund, as at the first day of the basis period, is below 750,000. Now, we have no idea what it means, but generally it means your capital, right? Your share capital, for example, your share premium, right? Your distributable earnings as of the first day of the basis period, if it's say 740,000, you continue to be exempt for that 1 year. Next year you do a test. If it is 800,000, then you have to pay tax. Okay? And when you pay tax, let's say the third year, you are now suddenly back to 600,000, no need to pay tax. Okay? So we do a test on your MF. Okay? Now this word MF, don't worry, everything is defined for it. Okay? But it means capital, what do you call it? Share capital and undistributable earnings. Okay? Now let's say, for example, now your members' funds is 1 million. Sorry, you're big. You have to pay tax. Okay? So if it is 750 or more than 750 as of the first day of the basis period, you are taxable. Okay? Now, let us say your members' funds is 1 million on the first day of the basis period, so you have to pay tax. Okay? Now, for cooperative societies, ladies and gents, there are 2 special deductions given to us against your total income. Okay? Now, what in the world is the total income? Now, that one, you must have already been experiencing. You must have seen this members' funds, right? This total income when you were doing a corporate tax form. Remember? So let's say, for example, you're doing a farming business or a restaurant business, right? You take your PBT, right? You add your depreciations, claim double deductions, right? A non-business income, your interest income, you bring to tax, right? Claim capital allowances, statutory income, arrived aggregate income, right? And for approved donations, now you can claim up to 10% from Y 2020 onwards, and you arrive at your total income. Okay. Now I'm going to ask you a question. Is there anybody who's not familiar with total income? Because you cannot do this question if you don't know what is total income. It's not possible. Okay. Now you have already done this before, right? You have already done this before. So it is nothing new for you, right? So you do a normal tax count, claim double deductions, right? You disallow the expense, depreciation, right? The normal entertainment expenses, right? Suppliers, all this normal, everything is normal, okay? So once you arrive at total income, ladies and gents, we're going to reduce it by 2 deductions. One is called the 25% deduction, and the other one is called the 8% deduction. It's called the 25% deduction and the 8% deduction. Okay. So in this case, 8% deduction. Okay. Now let me describe the 25% deduction first. Okay. Now let's say, for example, we have decided the corporate. Now you see, my wife, what she used to do is she used to pay. They used to deduct 10 ringgit per month from her salary, right? So if she's 1,000 ringgit, they will deduct 10 ringgit, and then every member, right? Now, do you know how many employees were there in Malaysian Airlines? Do you know how many employees are there in Malaysian Airlines right now?
We don't know.
In that case, ladies and gents, I'm sorry? Sorry, you said something? Sorry, you say something. Sorry, you can just repeat it, please.
40,000.
No, sir, nothing, sir.
Yes, yeah. You see, the thing is, now here, ladies and gents, as accountants, you must read the news. You must read the business sections. Okay, it's very, very important. Okay, as professional accountants, yes, we had 20,000, ladies and gents. We had 20,000, right? And then when we had the crisis, we reduced it to 14,000. Correct. It is four. In fact, right, you just now mentioned it. 14,000. Okay, so 14,000 employees. But today, ladies and gents, it's quite worrying, right? Because they want to fly, but they can't fly, right? The whole thing is so, it's really so anyway. And the government is actually doing everything possible, right? The government is trying to do everything. They're trying to help Asia, right? You know the story. But ladies and gents, you must be familiar with your surrounding. You must know your business, right? Spend at least half an hour to read the business sections, right? Of course, you got to do your studies and you've got so many other things to do, but you must also read the business sections, what happens in Malaysia and also globally, right? Globally, especially business news, right? You can, the other news is also important, but business news for us, for accountants, right? Professionals, we need to know, okay? We don't need to be remembering and this is not an exam, but we just need to know, okay? Now, let's say, for example, we've decided to set up a education trust fund. And 30,000 will be contributed to that trust fund. Okay, how much of profits you make, take 30,000 and keep it aside. And anybody who wants to take a loan, fill up a form, meet the criteria, we give it to you. Okay, ladies and gents, we want our members to focus on their career. They must do well, right? They want to further studies, right? And do with education. Okay, so let's say, for example, they transfer to a statutory reserve fund, right? So let's say, for example, they want to actually transfer, say, 10,000 to a statutory reserve fund, and then maybe a 20,000 for a furthering or cooperative education trust fund or development fund, right? For the cooperative members, right? Basically, it's for members only, not for anybody else. Okay. So let's say for the year, we actually contributed 15,000 for statutory reserve fund allocation and educational development trust fund of 15,000. So my total allocations is 30,000 for the year. What I will do is I will compare it to 25% of my published net profits. Okay. And I claim whichever is the lower. Okay. So here there's a formula. I take A, which is the amount transferred during this year, during the basis period. Let's say it's 30. I take 25% of my PBT, which is published, and I claim whichever is lower. Against my what income, ladies and gents? My total income. Okay. Now, lastly, there's another 8%, ladies and gents, right, of my members' funds. Now, here, my members' funds, let's say, is 1 million, ladies and gents. 8% is 80,000 I can claim against my total income. But if I was, say, for example, here, only 28,000, then this becomes 0. You cannot carry forward the loss. Okay, you cannot carry forward the loss. Okay. Now, for corporate societies, ladies and gents, they have their own special graduated rates, just like resident individuals, but they have their own rates that's given to you in your study text, so you don't have to rely on any other source. You have to just go to that and calculate the rates. Okay. Okay. Now let me restart from the top. Okay. So first 5 years from the date of registration, para 12 schedule 6 says is exempted. After 5 years, ladies and gents, are you a big guy or a small guy? Are you a big corporate society or a small corporate? If you are a small corporate society, your members' funds as the first day of the basis period is below 750, you continue to be no tax. No tax. Okay? But if you are 750 or more, then sorry, you have to pay tax. But ladies and gents, we'll give you 2 deductions at your total income level. One is called a 25%, and the other one is called a 8%. Okay? So corporate societies means any society registered in the Corporate Societies Act. And the tax computation is normal. You take your PBT, add less, all those funny things, right? All that you learned. And for the first 5 years under para 12 of 1A Schedule 6 says it is exempted from the date of registration, right? You have to still submit tax returns. So your accounting year end can be non-December year end, just like a company, right? So for under 21A, there are 4 persons who can do it on a non-basis here. That means you can follow your financial year end. Companies, corporate societies, trusts, and what we call LLPs. Okay, so you can have any accounting year end that is non-December. And after 5 years, a co-op having members funds of 750, less than 750, shall continue to be exempt under para 12(1)(b) of Schedule 6. Okay. Now, if it is given inside your study notes, then you have to write it in the answer. If there is a section given in the income tax stated in your study guide, so when they ask you, is it exempt or not, you have to answer it with quoting this section. Okay, you'll be getting marks for that. Okay. Now, let's say, for example, you are a big corporate society, you can deduct. So you can take a 25%, right, available for corporate, who's taxable after 5 years, and the maximum is 25% of net income for contributions to statutory reserve funds required under the cooperative or educational trust funds, and it also includes development fund established for furtherance. Let's say, for example, they want to give a loan for housing. Okay, members, if you want your housing loan, please fill out the form. You meet all the conditions, criteria, then we will give you a loan for which, of course, you've got to pay interest. Okay, so lower of amount transferred to SRF, and then compare 25%, you take whichever is the lower. And then the deduction of 8%, ladies and gents, is what we call against your members' funds. Okay. Now, ladies and gents, here under para 12, we have special rates for corporate societies under part 4, right? Now, let's say, for example, you are a member of the corporate society and you receive dividend income. It is tax exempt under para 12 and 12A, right? So, members receiving dividends from co-op used to enjoy a exemption under para 12 and 12A. That's why we are now under companies, you go to 12B. They didn't want to create another separate section for 12 for companies, shareholders receiving from Malaysian companies. So that's why you look at 12B. You go below, you'll see 12B. But any expenses attributable to that will be not allowed for tax purposes. Now, let's say, for example, the members, the corporate society is saying, look, members, we are going to build a building. We want you to pay us, give us a loan. Okay, we want to run our business. We want to start this farming business in Johor, right? We have this beautiful land. We feel there's a very good opportunity. So we are looking for loans. Now, let's say a member gives a loan. Let's say you give 100,000 and you get 1,000 interest. That interest is exempted for the member receiving the interest. Okay, it's exempted. And lastly, ladies and gentlemen, the only thing that you're not familiar with is what is members' funds. Okay, members' funds is your paid up capital or your paid up contribution, whatever you want to call it, but it excludes any bonus shares of revaluation reserve. So if you actually revalue your fixed assets or non-current assets, then that is capital that you have to exclude. Okay, so your statutory reserve funds, right? Your reserves other than revaluation reserves for fixed assets, non-current provision of depreciation renewal, diminution in value of assets is excluded. Share premium account and profit and loss appropriation balance. Okay. Now, business income, ladies and gents, and investment income would be taxed. So your restaurant business, your farming business, right? It's all subject to tax. Okay. But ladies and gents, when the members are contributing, remember my wife's 10 ringgit they were deducting, right? Does the principle of mutuality apply? Okay. Here I want to stop and discuss about this principle of mutuality. Okay. Now let us say, for example, there are 10 of us in this room, right? There are 10 of us in this room. Okay. So I go to every member and say, every one of you must give 100 ringgit. Okay, so everybody puts 100 ringgit on a table, right? They contribute 100 ringgit each. So I have 1,000 ringgit on the table. I go downstairs and buy a book called Forensic Audit, where we're going to read this book. Okay, so I go and buy one book and one coffee, and I come back and give the book and I give the coffee. But ladies and gents, I have a balance of 100 ringgit. So I go and give back 10 ringgit to each one of you. Here's your 10, here's your 10. Now, is that 10 ringgit your income subject to tax? Ladies and gents, is that your income subject to tax? Don't keep quiet, please. Is that 10 ringgit, the IRB come and knock on the door, oh, sorry, you made income of 10 ringgit, you have to pay tax. Is that your income subject to income tax, yes or no?
No.
You cannot be your income. How can you trade how can you do business with yourself? All you did was you took 100 ringgit from your right pocket, you gave it to somebody, you got back, they said, oh, I'll give you back a book and I'll give you a coffee. And then they give you back and 10 ringgit you put in the left pocket. One person cannot trade with yourself. Not possible. Okay? That, ladies and gents, is what we call the doctrine of mutuality or the principle of mutuality. We are basically mutual. That means the contributors and the persons who are participating are the same. The people, the 10 persons who contributed and the 10 persons who are getting this, right? But let's say, for example, I set up a stall and I start selling the book. That is dealing with non-members. That is subject to tax. That is business, because if I make a profit, let's say I bought it for let's say 30 ringgit, I'm selling it for 35 ringgit. That would be subject to tax. Okay, but I didn't do that. I am not dealing with non-members. I'm dealing with only members. Okay, but ladies and gents, this principle of mutuality for cooperative societies is not applicable. So you will be subject to tax on the membership subscriptions, right? And the members' contributions. So the public ruling has actually stated that the principle of mutuality does not apply for a corporate society. Okay, but when you're doing clubs later, We're going to do clubs shortly. When we do clubs, we will come back to the principal amount shortly, right? And that is applicable, okay? So another loss is CAs in claim, right? CAs in claim, right? So now, ladies and gents, if you look into your wonderful notes, right? So a corporate society is defined, right, as an unincorporated. Company is incorporated, whereas we are known as a corporate society is an unincorporated body of persons, right? And there's a public ruling called 9/2011 that was issued by the RB, right? And a corporate society is also one that is registered in Malaysia and includes a association, right? So this corporate society includes an association such as Farmers Association and Fishermen's Association, right? Now, foreign registered corporates are not recognized and be taxed as non-resident companies. So they had to pay tax on non-resident companies, okay? Now look at this point here. The principle of mutuality or the doctrine of mutuality does not apply to corporate society. Now, we don't actually quite agree with this, but unfortunately, we have to follow what the RB is doing, okay? Thus, income from mutual and non-mutual activities will be subject. So, we are actually dealing with members' activities. It is still subject to tax, okay? Now, permissible deductions include sums paid or transferred to SRF or educational institution or cooperative, right? Under 65A, sub A, and there's another. So, this one is, ladies and gents, referring to what deduction? This contributions to SRF under 65A is referring to the 25% deduction, and 65AB says there's a 8% of members' funds. Okay. And let's see what are the exemptions. So para 12 says first 5 years is exempted, and after 5 years, then we'll ask you, are you a big guy or a small guy, right? So here it is 750. If it is below 750, then you're small, no need to pay tax under para 12 schedule 6. But if you're big, then you have to pay taxes but claim 2 deductions. Okay. Now, what is MF? MS is given to you here, but it excludes any capital related, right? And what is the tax computation, ladies and gents? In your section 65A, you got 2 deductions. One is a 25% deduction, and the other one is a 8% deduction. Okay. And this is claimed against what, ladies and gents? This 35% and 8% is deducted against your total income. Okay. So let's look at this very nice corporate society. Okay. So S Cooperative was registered in 2000, operates a mini market, right? And so during the year, they contributed 90,000 of their corporates to an education trust fund, and the MF is 1 million. So MF is 1 million. Is it a big guy, big corp, or a small corp? The answer is it's very big. So therefore, you have to pay tax. It's not exempted. But can I claim the first 5 years registration, ladies and gents, for 2019? Can I claim the first 5-year exemption for the 2019? Is it exempted or is it taxable? Under the first 5 years, it depends. It's incorporated is registered in 2000. So until 2005 is exempted, but you are in 2019, so you can't enjoy that first 5 years. Okay. So you do a normal tax count, right? So your normal tax count, you go to your PBT, right? You add your depreciation, you claim double deductions, you less your dividend income, do a normal tax count. Okay. So take your PBT, right? Determine the chargeable income of Sun Co-op, no problem. So I take my PBT of 115. I less my dividend income. Okay. I add my depreciation, right? And then arrive at my adjusted income. If there's capital allowances given to me or not. No capital allowances. Okay, good. So no capital allowances, no need to worry. Right? Arrive at my statutory income, arrive at my aggregate income, arrive at my total income. But total income you must stop because you can claim 2 deductions. Okay? So 2 deductions are, one is 25%. So what I'm going to do is I'm going to take So what I'm going to do is I'm going to do 25% here and 8% here. Okay, so here I'm going to take the amount contributed. I'm going to take how much? The amount contributed during the year was, amount contributed during the year was 90,000. Okay, very good. So 90,000, so 90,000. And I got to compare it to 25% of my PBT, net profits. In this case, it will be 25% times how much? PBT is 115. Okay, very good. So 115 is, so in this case, so it'll be slightly higher than, slightly higher than 25,000. So it's 28,750. And I claim whichever is the lower. Okay. 8% of my members' funds is given to me as, in this case, it'll be, hopefully, I'm very bad in mathematics, so I will take my total income here. So my total income is it's given to me as 130. Okay, so 130. It's 130. So my chargeable income, ladies and gents, my chargeable income is 21. Ladies and gentlemen, how can you get 106 to? It's very funny, right? See, if I take 750 plus 0 is 750. It's not 160. There's a mathematical error here, right? If I take, see, 28 plus, right? So I got to add, it's basically 108,250, right? If I take these two, it has to be 108. It has to be 108,750, so it cannot be. So there's a typo error there. So there's a mathematical error there. So you need to rectify this error. So it is 21,250. So this is an error here. It's a casting error. So you need to change this and change this. Okay. Okay. And also for corporate sites, ladies and gents, you can claim 2.5% aggregate income for Zakat Penyagaan. But Zakat Penyagaan is compared to 2.5% aggregate income, and the tax rates are given to you, just like individuals you use, right? So in this case, my tax is going to be how much? Based on 21,250. The first 30,000 is cost on. So my first 30,000 is cost on. Some tax payable is cost on. Okay. But let's say, for example, I had 100,000 here. Let's say it's 121,250. Okay. In this case, what I'll do is I'll go to the first 100,000. It's 5,500. Okay. So the first, my CI is 121. Okay, so first 100 is the first 100 is given to you as how much? 5,500. And the balance, right? The balance is 21,250. Is how much? The next band after that is 15%. So times 15%. In this case, times 50%. So I'll have to pay. It's very small tax, very small. You see, compared to companies, it's very high. Companies is much higher. You got to pay at least 24%. Right? Depending on SMA companies, slightly lower. Okay. Ladies and gentlemen, may I ask you, is there any questions? Ladies and gents? Is there any questions, please?
Sir,
Yes, please.
if it's within the first 5 years, then we don't have to compute lah, right?
No, you just arrive at a charge. You need to do a tax com, but you don't have to compute and pay taxes. You need to submit a tax return. But you can say that I qualify for exemptions, and you got a quote, right? That section para 12, sub 1, sub A, and then you saying that you are exempted under that provision, and then you got to submit the tax returns. Okay. So I will ask you whether you are enjoying any tax incentives, and your answer is yes. Okay. But they'll be actually verifying, whether you're telling the truth or not. So they'll do a tax audit later. Okay.
Okay.
Just give me a minute. Let's look at this. Now, this is a question from 20181M. 1 main, okay? 218 1 main. So if we look at question number 3A, okay? Now I want you to read this question. Okay? It is quite a high mark, but it's likely that you will not be getting so high a mark. Okay. Okay, so I want to read this question, and they're asking you, for our cooperative society, is it taxable for 2016, yes or no? If yes means compute. Now, ladies and gentlemen, I want to tell you now, for 2016, is it subject to tax or not subject to tax?
Subject to tax.
Sorry, I heard something else just now. What? Is it yes or no for 2016?
Yes.
Yes. Yes, sir.
No.
Yes. No.
Then
No.
we gotta wait, because if there's a yes and no, then we have to do an election start. So we got to go to the elections now, right? So now, why did you say yes? Why did you say yes? It is subject to tax for 2016. You said yes, right, just now? Can you tell me why you said yes?
Because the balance of members' funds for 1st January is 748,000.
Yeah, so does it allow you to enjoy an exemption or does not allow you to enjoy an exemption? If you're
Subject
below,
to tax.
sorry?
Because it's more than
Below
100.
750 exemption.
Mm.
Okay, so let's look at it again. Now we start, because I think I ran a bit too fast. That's why you're not able to understand it faster. Okay, now here, if you look at page 10-2, it says para 12 schedule 6 gives an exemption under two circumstances. One is, but the first 5 from the date of registration is not applicable for us. It doesn't apply because we are more than 5 years, right? We are in 2015, so it doesn't apply to us. Okay. Now for the second case, they're asking you if your MF on the first day of the basis period, right, is below 750, yes or no? The answer is
Oh, no. Okay, understand. Not subject to tax. Exemption?
but why do you say yes then? So did you read it as a 748 instead of 748,000? Is that what he's saying? You read it as, it's 748, right? No, but what made you say yes?
Or maybe I
Referring to what?
didn't.
No, it can't be because it's not this schedule. I mean, your para 12 clearly says no need. You are not falling under the category. Okay?
Yes.
Then they're encouraging you. No, please go and help your members, right? Go and help them, whatever they want. You focus, right? And you will help. Okay, now coming back to 2017, sorry, you can't enjoy the exemption anymore because, right? And once for this year only we're talking about, huh? And in 2018, you're back to 600,000. No need. Your MF is 600 is 748, 170, 49,000 pun upper. No need. Okay. But ladies and gents, for 2017, I'm very sorry, you have to pay tax. So what you do is you take your PBT, then you go and make these adjustments that is included inside here, right? You less and add, and then you make 2 deductions. Okay. Now, what are the 2 deductions, ladies and gents? We know it as numbers, right? It's easier to remember the numbers. It's a 25% and a 8%. Okay, so you arrive at the total income. Now, what is the total income? What is the total income? How much is the total income? So you take your 170 and then you less your 30 and then you have to add your depreciation. Okay. So in this case, ladies and gents, you arrive at your PBT, then take your PBT and you make certain adjustments. Okay. So the tax form is relatively straightforward. Okay. So they're testing more on principles. So as long as you know the principles, you are okay, here. So 216, no need because your members' funds is below 750. So para 12. So no need to pay, no chargeable income and no tax payable. Okay. So in this case, right, your PBT is 170. So you less and add. So your total income is 180. So there are 2 deductions. One is a 25%, and you compare it to the contributions you made during the year, right? So in this case, your contributions is lower, so 42,500, and 8% of your members' funds, right, which is given to you, and you take 64. So you minus this, you arrive at your chargeable income. But ladies and gents, is this correct? Is this correct? I want you to look at the corporate society rates given to you and tell me this is correct or not correct.
It should be tax on the first 60,000.
Yes. The poor little examiner, he was, I think, rushing, right? I think his wife was quite upset with him, so I think he was rushing, I think. So he went and used the wrong rates, right? So in this case, he went and used the wrong rates. But what he did was he actually used these rates. He went and used these rates. He went and used the rates for individuals, resident individuals, which is given to us on page 1. Okay. See the page 1, right? The page 1 says, you look at these rates. Now, this rates is actually not for corporate societies. It's actually for resident individuals. So he went and used these rates. Poor guy, right? So that is not correct. So here the rate is, so here the rate is, you follow the rates that you just now were mentioning. So if it's 70,000, you go to the first available, which is chapter corporate societies. So it's first how much? First 60. So first 60 is 1.5, and then the balance is at 10%. Okay, so balance is 10%. So sorry, Minta Maaf, you need to rectify. So first 60 and then balance, the 15 one is at 10%. So you'll get a different figure. Getting sense? Now, if you get, the likelihood of you getting a question, because it's quite straightforward, is very low. But if you get a question like this, you can score good marks. Okay. Okay. Now, ladies and gentlemen, let me ask you if there's any questions. And also, dividend distribution by members is tax exempt. Now, we just want to move. This is only a slightly complicating trade association, and then there's clubs and charitable organizations. Then what we'll do is in the next class, we will go to 9. We'll start off early morning in the 9 because I need early, fresh for chapter 9. It needs the leasing. It needs a little bit of special attention. Okay, but trade association is nice. Okay, if you get a question on trade association, nice. Okay, so I will actually move on to trade association. But before we go to trade association, it's just full of notes. Okay, it's full of notes, so we will come back to this later. Okay, I want to go to the summary version first, which is slightly user friendly. So trade association is 27. Trade association 27. Okay, so let's say, for example, we are all of us, right? All of us are in the business of selling gold, jewelry, and diamonds, right? We are in the gold, jewelry, and diamond business. So what we will do is we will actually be setting up a trade association to discuss matters that affects us. So what is the gold price today, right? Is the price going up or going down, right? Is the supply, can I get my supplies on time, right? Is the supply chain disrupted, right? So there are various issues that we're going to discuss. Say, for example, now you're in the accounting, right? So accountants, we actually have this MICPA, right? And also MIA also is another trade association. So of course, we won't be discussing the gold prices in our MICPA. We'll be discussing whatever that relates to accounting, finance, and tax, right? Like, for example, one of the important issues that MICPA and accountants will be discussing is the budget. There's a budget coming up next month. So whatever that affects the members, right? So Freight Forwarders Association will be discussing whatever that affects their business, right? The Federation of Malaysian Manufacturers, FMM is a Federation of Malaysian Manufacturers, will be actually discussing about issues relating to manufacturing. Like, for example, right, I want to import certain goods, right, but I port client, I cannot release, right? They're asking me so many questions, right? So can you help me out? Okay, so we discuss all this, right? But of course, ladies and gents, to maintain a trade association, you have to, right? You have to start paying contributions. So let's say, for example, there are 10 of us, right? We will now contribute, right? Say 1,000 ringgit a month. So what are we going to do with 1,000 ringgit? We're going to maintain an office. So I will be incurring rental expense. I have to employ employees to manage the trade association. So I'll have salary costs, right? I have to have audit fees, all those expenses, stationaries, right? But am I actually doing a business? Okay, am I doing a business? Okay, so in this case, now, let's say, for example, we're organizing a seminar. Okay, we are organizing a seminar on the latest developments in the gold and jewelry business. So those who want to come, please come. But of course, you got to pay 500 ringgit, right? Right? So you got to pay 500 ringgit for a one-day workshop, maybe 300 ringgit one-day workshop. Because those days we used to get a lunch, but now it's no more lunch because everything is virtual. So it's not going to be as expensive, maybe 50 ringgit cheaper, but that's how we make money, right? So we will make a seminar, and then we have to employ a speaker, right? So we're getting a speaker from Johor and Singapore to come, and we have to pay them, right? Of course, there'll be expenses. Okay, so here, ladies and gents, right, if you notice, trade associations are associations of partnerships. Main object is to safeguard or promote the business of its members. So it depends on what association you're talking about. Okay, so if you're talking about a trade association of freight forwarders, they will discuss freight forwarding. Okay, so developing and advancing the profession of its members. So, for example, accountants and engineers, right? Architects, right? So they will be discussing, right, issues that affects their business, right? Their industry, right? So architects, engineers, right? Auditors and accounting, right? But it's not a partnership. Trade association is not a partnership, right? It's treated as a body of persons. And you'll be resident if your management and control of its business during the calendar year is exercised. So the test, whether you're resident or not, is what we call the so-called MNC test. What is MNC? Your management and control of that trade association, is it exercised in Malaysia? The answer is when you are resident, right? If you're resident means you'll be able to enjoy certain special treatment, okay? So residents are taxed at individual rates. Now here, ladies and gents, is very unique. Here, you will be taxed on the resident. Remember you saw that remember the first page? I showed you something for resident and then the examiner used for the corporate society the wrong rates. You will use that rates for trade associations. Okay, and non-residents are taxed at 30%, would be the fact from 2020 onwards. Okay, but ladies and gents, now the membership subscription fees is given a special treatment for a resident trade association. Okay, if you're a resident trade association, 100% of your MS is exempted. 100% of your membership subscription is exempted. Okay, but all the others, your entrance fees, your business income with members and non-members, right? So in this case, everything is, so you're having a seminar that is deemed to be a business source income. Okay, so membership subscription is deemed to be a business source, right? Your investment income is taxed separately. Your interest income is subject to tax, dividend income no need to pay tax. But there are two things the IRB wants you to do. Okay, so if you're having, let's say, membership subscription fees. Okay, so let me go to this, show you how it works. Okay, now let's say, for example, I have this membership subscription is 600,000. So my gross income is 600,000. Let's say my seminars is 1 million. So my total is 1.6 million. Okay. Let me just explain this to you. Okay. Okay, it's easier this way. Okay, let me just explain to you. Okay, so let's say, for example, I have membership subscription of 100,000. Let's say I have a seminar of 200,000, and let's say another trading, I have another activity, a business activity, and let's say my gross income is 300,000. Okay, so my total from my deemed business source is 600,000. Okay. Let us say I have some direct expenses. So, say, for example, for my seminars, I had to pay a speaker to speak. I had to rent a hall in a hotel. I have to pay rentals. So these are what we call directly deductible expenses. Okay. So you can claim the direct expenses. Okay. Now, let's say, for example, you have some common expenses. Now, what are the type of common expenses a company will, trade association will have? Salaries, right? Rentals, right? If there's any stationaries, right? Your printing costs, all that would be, let's say, 60,000. What you're going to do is you're going to apportion the common expenses based on the gross income. Okay. But what the RB is actually saying is this membership subscription fees is exempted 100%. But they want to make sure that when you're allocating the expenses, you also must allocate it here, because they don't want you to claim the common expenses against taxable income. Okay, so your seminar is taxable, your events are taxable, and is your business source. So they want to make sure that you allocate. So you got to take 100,000 divided by your total gross is 600 times 60,000. You got to claim 10,000 here. RB is worried that you might overclaim the expenses against taxable income. Okay. Now, let us say, for example, you have some common CAs. No problem. You do the same, right? So you allocate the expenses based on your gross income to all the deemed business source income, right? You don't have to bring it to interest income. It's not business income. So you don't bring it to into the calculations. So your denominator will include 600, including any gross income from membership subscription, which is exempted. Okay. Then you arrive at your statutory income, and then you minus your this SI from membership subscription is exempted 100%. So you minus this and you pay tax on SI, which is taxable. And you have any non-business income, like interest income is taxable. So you bring it to tax and then arrive at a chargeable income. And then for resident individuals, you use, right? You use what? You use what do you call resident individual rates, right? Resident individual rates. Resident individual rates. Okay, so let's just summarize. So when you're doing a trade association, remember the membership subscription is given a special treatment. If you are a resident trade association, your gross income, your income from MS is exempted 100%. But what the RB is actually wanting you to do is they want you to make sure that if they have any common expenses and common capital allowances, you have to make sure that you allocate it to all the expenses, right? They don't want you to just claim, they want you to make sure they allocate it to all the deemed business income. They don't want you to claim, say, you take 30, I take 30, and take Kosong here. That the RB is saying is unfair, because they're saying that this income from the MS is exempted 100%. Okay, same thing for capital allowances. Same thing for capital allowances. Okay, same thing for capital allowances. Clear that? Okay, now let us look into your notes. Okay, now, a trade association is defined in Section 53. So 53 covers trade, right? So any body of persons, right? And there's a public ruling also that's issued. And resident status is dependent on the management and control is exercised in Malaysia, then you become resident. Okay, so they will be taxed. Residents are taxed at individual scale rates, and non-residents is taxed at 28%, and then from 2020 onwards, it is 30%. Okay. Now, under the gross income, a trade association is deemed to have interest fees and subscriptions, right? So this is a deeming provision. Okay. So what's the meaning of deeming? That means even though it's not a business income, it's deemed to be a business source income. Okay, so your membership subscription fees, right? Your entrance fees, your seminars is all deemed to be business. Okay. Now here, ladies and gents, there was this big issue about how much should be exempted. So under the old rules, only 50% of the statutory income from membership subscription was exempted, right? But from 2005, ladies and gents, from 2005 onwards, right? From 2005 onwards, the income from MS is 100% exempted. So please, right, don't take into account all this old orders. You only highlight the 2005 order, which says that 100% exemption is only given to member subscriptions. All the others are subject to tax and treated as deemed business source income. Okay, but if there is any common expenses and capital allowances, then you can only claim a certain proportion of those expenses based on the formula. What's the formula? Remember what you saw earlier? The formula was the gross income for, say, seminars divided by the total gross income from your deemed business source times 60,000. Okay, times 60,000. Okay, times 60,000.
Mr. Ravi, the last sentence there, in practice, however, it appears that this is treated as the same source. Meaning
Yeah,
in practice.
see, business is non-members. Where trade association conducts business with non-members, such business is treated as a separate business under 53.2. Okay, so common expenses will have to be apportioned between deemed business and the separate business, right? But CA is also given if applicable. In practice, however, it appears that this is treated as the same source. So even though you're actually dealing with members and non-members, right? So they are actually, technically speaking, two separate businesses. But in practice, what we do is, right, we just combine these two, right? We don't segregate whether it's members or non-members, right? The only thing that we segregate is the membership subscription fees is separately assessed. Okay, you need to identify the membership subscription, right? Which I will show you, right? I need to explain to you in a better form by showing you how it works through an exam question so that you'll be able to understand this better, okay? So let me just go to this question. And yes, it's got it. Okay, so let me go to 2018. 2018 T3 sub. Okay, 2018 T3. 2018 T3 sub. So here I have. Okay, now I just want to read this question first. Right. This is a 2018 T3 sub. Okay, just read this question first. Now, if you notice, in terms of the income streams, right, you have an MS, you have seminar, and you have another trading business, right, trading activity. And then you have a non-business, you have an investment income. Okay, so you have investment income here. And then you have certain expenses which is not particularly connected to any source, so it becomes a common expense. But this rental of seminar expenses is relating to only one source. It relates to this source. Okay, so this rental of seminar expenses is a direct expense. Okay, it's a direct expense. Okay, now this consultant fees is relating to this source, so it's a direct expense for this source. Okay, now of course depreciation is not allowed, right? But you can claim the salaries, audit fees, and your telephone charges and printing station as your common expenses. And they also got a common CA of 60,000. Okay. Now, what I'd like you to do is, right, determine the exempted income from MS and compute the tax for this DZ Trade Association. Okay. Okay. Now, I want you to use this format. What's the format? Take the gross income from each source. I mean, of our trading activities, right? Add a total. Then any passive source, right? So your passive source is interest income. You show it here separately, right? And then claim the direct expenses, and then allocate the common expenses based on the gross income, and allocate the CA, which is given to you based on the gross income, and then arrive at the SI and determine the SI that is taxable, exempt and taxable, and then arrive at your aggregate income and chargeable income and your tax. Okay, so why don't you just use this format? Okay, what's the format? Your gross income less direct expenses, less common expenses, less CA, and arrive at your SI. Why don't you just give it a shot? Gross income, less direct expenses, less common expenses, and less common CAs. Okay, so your MS is one stream. Your seminars, your trade is all deemed business source, and interest income is passive, so that you don't bring it as a part of your denominator. Okay, and then claim the direct expenses, claim the common expenses, and claim the common CAs, and then arrive at your SI, and then arrive at your aggregate income and chargeable income. So I want you to tell me what is the MS that is exempted. So what is the MS exempted, ladies and gents?
The 500,000?
Sorry?
The 500,000.
No. The MS exempted, you must minus.
Oh, after deduct.
Oh, you cannot just take you cannot take this alone. You got to minus, make sure you take the common expenses attributable to the MS exempted and the common CA attributable to this. Only this is exempted, not this. So the RBI wants you to allocate a certain part of the common expenses here and certain part of the common CAs here. Of course, you don't have any direct expenses, so you only have common expenses and common CA. Okay, so in this case, ladies and gents, the MS is 500,000. Okay, so what I'm going to do is I'm going to take and put it inside $500,000. $500,000. Here will be 800,000. And this is trading equities. So that is 150,000. So my gross income, right, and my passive source interest income is how much? 50,000. Okay. So what is my common expenses? Okay, so I claim my direct expenses first. So if I've got any direct expenses, I can claim. So I got my rentals here. It's 200. I have a what do you call it? Trade association. What is it? The 20,000. Here is 20,000. Okay, so my direct expenses. Okay, but what is my common expenses? Right? What is my common expenses? So my common expenses are made up of my salaries, audit, so 270, 280, and 300. So my common is 300. And my common CA is given to me as 60,000. So now, ladies and gents, with this format, you should be able to get the answer. Okay, so I got my common CAs here. Now this is correct. I've already refreshed. So I can claim these expenses and claim these expenses. Okay, now how do I allocate this 300,000, ladies and gents? I'm going to take 5 divided by 1,450, correct, times 300,000. Okay, here will be 800 divided by 1,450 times, and how much? 300. And here will be 150 divided by 1,450 times 300. Okay. Okay. Now, how much is it? How much my common expenses based on that formula, ladies and gents? How much is it?
20.69.
Yeah. So it'll be a negative. The common expenses allocated is right. So if I take 500 divided by 1,450 times 300 times 300. Is it not this figure?
Eh, wait.
Is that bigger?
Yes.
Yeah, it's this figure.
Oh, yeah, correct. That is what was capital allowance. Okay.
Yeah. So it's actually not 360, it's actually 300. Okay. So it's 103 here. So it's negative, right? It's negative. So I need to put a negative here. And then I will do the same for seminars, right? I'll do exactly the same. So what the RB wants you to do is you split across even the exempt and non-exempt. Okay, that's why you need to show these figures. Okay, even though it's exempted here, you need to show it. So you will actually do the same thing here. Now, how much is my common CAs? So I will do the same thing, nothing new about it. So what I'll do is I'll take 500 divided by 1450 times 60. Right, so if I do the same thing here, 500 divided by 1,450 times 60, I should be able to get about 20,000, right? Yeah, 20,000. Okay, and here I get 2690. Okay, because I'm actually quoting everything in the appropriate right, in the I'm actually showing it as in thousands. Okay, so well, you got to do it in full figures, huh? I'm just showing it in thousands, but you have to write in full. You have to write 500,000. Okay, so in this case, then you take this, you take the 500,000 and plus this and plus this, you should be able to get you should get about 375. 375. Okay, so 375 is exempt. So you do the same thing for the allocation for seminars. So in this case, your seminars is how much that is given to you. So in this case, it'll be 165, right? So it's 165. And here it is. Your common CA is also given to you under seminars is 33,000. Okay. So you arrive at SI, right? Arrive at SI and $198. It is 402 approximately in rounding up. And here also summer, I actually allocate my trade association is 31,000. And here it is. Here it is. How much given to you is 6,000. So here is about 93,000. Okay, so I take these, I take all three, and combine it, and then I reduce my exemption here. So it'll be minus. So here I'll have a new figure. Of 495, and then I add my interest income, which is 50,000. So my aggregate income is 5 for 5, and I don't have any donations, so it'll be and my resident tax rates will be based on this figure. So if you look at the answer, right, it should give you an idea. Okay, so it'll be good if you can actually do it through a landscape. It actually saves you a little bit of time, because if you do it in a portrait, it'll take some additional time because you got to repeat the CA writing and repeat the common expenses. So if you do it in a landscape, then you can save some time, but eventually you need to add all the SIs and then minus the exempt. Okay, so in this case, your MS exempt is 375, and your taxable is 4 plus 90 is 494. You add your interest income, claim your donations, right, at 10% from 2020 onwards against aggregate income for approved donations, cash donations, and then your tax rate is correct. So I think the answer here is correct. They use the resident tax rates. Okay, and your common expenses are 250, 20, 20, and so it's altogether 300,000.
Mr. Ravi,
Yes,
why the calculation for seminar fee and trade associations activities need to be done in two separate columns when
you may
they
have
are
certain
both taxable?
expenses. See, your seminar, you may have some direct expenses attributable only to seminar. Okay.
Yeah, but if you add up the two income, you can also add up the two direct expenses. So you will end up getting the same.
Yeah, fine. I mean, that's fine. But let's say, for example, now let's say, for example, they have this dragon dance. Let's say let's say, for example, now this trade association has some members are very good in dragon dance.
Okay.
Okay. So some is very good. Like you are very good in speaking. So you are giving the seminars. I'm very good in dragon dance. Right? So now why do you want to give business to somebody else, right? So I will do it to you. I will give money to a trade association. So, but that is not considered to be the same business. It is business. Yes, we agree. Your point is it's business. So why do you want to separate? But it is not the same business as such. Okay, so that's why we need to actually treat it separately, because I may have certain expenses which is unique to my trading activity, and yours, you got to pay rental for your seminar hall, whereas I got to pay rental for a lorry. So that's why we tend to segregate it. But I agree with you that ultimately the answer is the same, unless of course you have a loss, then of course it doesn't, right? It's different, but otherwise it is. It's fine. So that's why we actually segregate it. Okay. Now coming back to the question that you were asking in the paragraph. Now, technically speaking, the cap allowances you need to segregate between members, right? Income from members and non-members. But in practice, what we do is we just take common expenses and then we allocate it to both members and non-members, as long as we allocate it to the main revenue, the main deemed income business sources. So we don't segregate between business revenue, rental of the seminar hall and the seminar fees. You're getting both from members and non-members, right? Because you might want to open it to non-members also. So we don't actually have to segregate it. In practice, we just combine it as, right? Both are combined, and we claim the cap allowances against that main revenue source. Okay, ladies and gents. Now, is there any questions? Now, before I let you go, right, I think we're going to stop shortly. Before I let you go, I'm going to just go to one topic, and let me just finish that off. Then be much easier, right? So if I was to go to a club, the concept is very easy. Okay, here the concept of mutuality applies. So in a club, right, according to the public ruling, so you go to page 12. So if I go to page 12. Here, ladies and gents, here in the public ruling, they have clarified that income from transactions with members is not subject to tax based on the principle or doctrine of mutuality. Okay? So any entrance fees and members fees from the members, no need. Your drinks sold to members, no need to pay tax. What you're doing is, remember 100 ringgit I took from all of us, and then I went and bought a drink. So the 100 ringgit is not subject to tax, but you cannot claim the cost, because the cost of the drink also is not deductible. It's not deductible, because the income is arising from a mutual transaction. Okay, it's based on the principle of mutual, right? Income arising from mutual dealings, right? Mutual dealings. So amounts paid by members to attend dinners, no need to pay tax, right? But the expenses also, you make sure you cannot claim. And amounts paid by members to attend a talk, no need to pay tax. So you segregate between members and non-members. Okay. So let's look at a simple example given in the public ruling. Right. Let's say, for example, there's a senior citizens, say, reading club. Okay. So they give you certain receipts from members and non-members, and certain expenses that is incurred in the club. Okay. So in this case, the members' subscription fees under the principle of mutuality for clubs is not subject to tax. So income from transaction members will be in the receipt, will be in the accounting system, will be actually captured as members. So the 20,000 is not subject to tax. The members' entrance fees, it is not subject to tax. Sale of tickets, 10,000 to members, no tax. But the sale of tickets to non-members is subject to tax. Okay, so the sale of tickets to non-members is subject to tax. Okay, your interest income, of course, from an external party and rental from an external party, that will be so. The 8,821,000 is subject to tax, but the gross non-taxable receipt would include members and entrance fees. So therefore, you don't have to pay tax. Okay, and of course, when you're declaring your tax purposes, you can claim the expenses attributable to the non-members. This 4,000 you can claim because it is relating to 8,000. So you can claim the 4,000 and your chargeable income, right? And your tax rate, right? Your tax rate is using resident individual scale rates. if the trade association is resident. Sorry, it's a club, not a trade. It's a club is resident, then you use the scale rates that you saw on page 1. Okay, and if there's a small, if there's some expenses that is applicable, there's some common expenses to both members and non-members, then you allocate it, right? You claim the non-members portion, but you got to claim based on the common expenses allocated to non-members based on the combination members and non-members. Okay. Okay. So when you come back next, ladies and gents, right? Unfortunately, I couldn't finish this today until by 11:30, but I didn't want to rush it. So when we come back next, what we will do is we will do clubs. Then we'll quickly go to charitable institutions, nothing much. Then we go back to chapter 9, and then we can go to chapter 11, 12, and 13. Okay, we can do 11, 12, and 13 in the next class, and then after that we can finish off. The last 3 chapters are very straightforward that we should finish off very fast, but the next class is very important, so we will do it on Monday. So on Monday, what we do is we do on Monday we do 9, 10. We do a little bit of club, and then we do 11 and 12. But we need to do 12 and 13 together, so we need to do this on Monday. But there are certain topics like charitable institutions is relatively straightforward, so we don't have to spend time. And the club, I want to do one exam question, and then we can finish off with. And there's an investment holding company here, right? Dr. Salva, have you finished with the incentives?
They have learned what do you call
Chapter 22 and 23.
22 and 23 not yet. They have learned industrial allowance apa? Finance status, investment tax allowance, reinvestment allowance. Those have been
They've done that. They've not done the what we call principal hub and all that, the other incentives.
No.
Okay. So that takes a little bit of time because it's covered in chapter 23 also. So we will do this. So next class, right? The next 2 classes we have is we'll focus on this. Ladies and gents. And the last one, the 14, 15, and 16 is one area. 15 and 16 has never come out before, right? Because it is quite easy, it seems. I don't know. But that we should finish off fast. But we need to finish these. The next 2 classes very important for us, right? So we should be able to wrap up in the next 2 classes. Let's see how.
14, 15, 16, the trust estate settlement. That one I have covered during the first week.
Oh, great. Oh, wonderful. So that means for the next 2 classes, right, we have only these topics, right, Doctor?
Yes.
You correct to say that?
Yes.
Okay.
Yes.
So then in that case, we can wrap up for the next 2 classes. That gives us enough time. It's about 3 hours. So we will wrap up by the next 2 classes. Right. So on next Monday and Wednesday.
Okay.
Okay, ladies and gentlemen, there's no other questions, and I've already taken up enough of your time, right? And is there any questions?
Students, if let's say you have questions, you can pass to me, and then I will pass to.
I think Doctor will take over. Okay. So then in that case, take care and see you all soon. And please be careful, okay? Stay safe. Take care.
Thank you very much, Mr. Ravi.